Good morning and welcome to day 2 of the 50th Annual Estate Planning Seminar. We hope you enjoyed yesterday's presentations and took the time to visit the networking lounge to continue the discussions. If you haven't had a chance to visit our sponsor booths, please take a minute today to go say hello. Today I would like to start out by recognizing our bronze sponsors. As you know, our seminar is supported by our great sponsors, and especially this year when we had to make the switch to virtual, we wouldn't have been able to do it without them. Our bronze sponsors are Buckley Law, Cable Houston, Dunn Carney, Oregon Public Broadcasting, Samuels Yolen Cantor, Schwabe Williamson Wyatt, Stillwell Reeves, Tiedemann Advisors, and Top Colbush and Home. I'd also like to recognize our seminar planning committee. The seminar committee includes myself, Joylyn Ankeny with Aldrich Wealth. I was co-chair this year with Michael Walker, who's with Samuels Yolen Cantor. The rest of the committee includes Rebecca Bibelheimer with Oregon Community Foundation, Sari Crothers with Washington Trust, Will Hammerman with Wells Fargo, Samantha Paulo at Ferguson Wellman, Kim Spalding with Perkins & Company, Kara Stoddart, who's in transition to Catalyst, Catherine Van Zanten at Cable Houston, and Michelle Wasson at Riverview Trust. And before we start our first presentation, let's take a moment to acknowledge the Estate Planning Council Board officers: President Joshua Husbands, Vice President Eric Hormel, Treasurer Catherine Coakley, Secretary Catherine Van Zanten, Past President Mary Lago, and our at-large directors, Karen Hobson, Samantha Paulo, Richard Pogue, Kim Spalding, and Michelle Wasson. And now the part you came here for. I'd like to introduce our first presenter of the day, Paul Lee. Paul is the Chief Tax Strategist at the Northern Trust Company. He's on the Heckerling Institute Advisory Committee, the Bloomberg BNA Estates, Gifts, and Trusts Advisory Board, and the University of Florida Tax Institute Advisory Board. He's an ACTEC Fellow, and he's been inducted into the NAEPC Estate Planning Hall of Fame. Paul is a frequent lecturer and panelist on investment planning and tax and estate planning. His presentation today, titled COVID-19, Covfefe in Congress, will discuss straightforward and innovative planning opportunities for families and their businesses that best take advantage of both the expiring and permanent provisions of the TCJA with an eye toward anticipated changes to the future planning landscape. Let's go to Paul.
Good morning, Portland. It is wonderful to see you all. I guess it's an understatement to say I'd rather be with you in person than doing this virtually, but at least we have the opportunity to visit with each other, and hopefully this dumpster fire will die out relatively soon. So with that, let's go ahead and jump into this. Top tax and estate planning techniques in today, COVID-19, Covfefe, and Congress. Just a note about Covfefe. I do find it pretty funny when folks take umbrage about the word Covfefe. For me, it is meant to. For me, it's meant to mean sort of the chaos and insanity that we've sort of been going through. And when people sort of take umbrage about it, they think it's a political statement, which it is not. It is more to express the sort of inexplicable, undefinable chaos we've been going through. And anybody who has an issue with it, just tell me what Covfefe means. And so I'll tell you a joke about the word Covfefe. We know it is the tweeted, the former President Trump's tweet with the word Covfefe, and with the insistence that it's a real word and it means something, but without any definition of what it actually means. So what I would say here is, if you want to know what the word Covfefe means, you can find some guidance from actually it's about a year and a couple months ago. There was a horse by the name of Covfefe that won the Santa Anita race and won $1 million. And so the only indication of what we know about Covfefe is it comes from a horse or comes out of a horse. And so with that, let's just jump into this and let's see if we can move this forward. So nothing on this slide is going to surprise anybody here. This is, we all know what we've been going through. We all know we are running enormous deficits already, with anticipated more relief packages coming along. We know interest rates have plummeted. We know, notwithstanding what the stock market is saying in terms of its values, that many privately held companies in many industries, like the restaurant industry and the airline industry, are going through severe problems. Now, from a response standpoint, we all know that this is a great time, with asset levels being depressed. This is a great time to transfer assets out of the estate. We know that interest rates are near historical lows. We can fully anticipate higher income tax rates to respond to the deficits, the historically high deficits that we will be going through. But I think we also know that our clients are very anxious and they're fearful about what the future might bring, both financially and maybe from a medical or a health standpoint. And so one of the keys that we'll talk about is how do we build in flexibility for our clients? How do we make sure that we build into the planning that we recommend for them the ability to keep cash flow for the rest of their lifetime, the ability to get at those assets if they need it, maybe even the ability to undo the transfers that we are recommending. And so that is the common theme that we have today. So we have to look at the current estate planning landscape. And of course, given the makeup of Congress today, we need to look at what the future might bring in terms of potential future tax legislation. So let's start with where we are today. You all may recall at the Portland Estate Planning Council, this is a slightly updated chart of the Venn diagram that I have used for many years and that I used with you all the last time I was with you. It's the Venn diagram. It is the unholy circle or the holy circle of estate planning in my mind, at least under the current landscape. You know, with transfer tax rates where they are today, with exemptions as high as they are today, it is not just about avoiding the transfer tax, which is the green circle. It is equally as much about the income tax, maybe even more. And the literal overlap is the Section 1014, what I nicknamed the unlimited step up in basis. And what I mean by the unlimited step up in basis is, remember, under the current state of the law, you get a step up in basis on appreciated assets to fair market value, regardless of whether or not you pay any estate tax at all, at least federally. Now, your state, just like my state, still continues to have a state estate tax. You guys have a relatively low state estate tax exemption, but let's put this in perspective. You are talking about a maximum 16% state estate tax in both of our states. And when you compare that to the potential savings on capital gain assets, by way of example, of 23.8 plus Oregon state tax plus New York state income tax, typically this is a fair price to pay in order to get a free step up in basis. And you may recall, I talked about, well, tax basis management is the name of the game, especially when we are still going through a pandemic. We are still going through something like 2,000 to 3,000 deaths a day. We need to be prepared for unexpected mortality in our client base. And, you know, maybe we might be able to, at least from a financial standpoint, take advantage of that by being very smart from a tax basis management standpoint and by having inclusion and, at the very least, on a very sad occasion, getting a step up in basis for the descendants, for the heirs of the poor decedents. Now, you'll notice the Venn diagrams were pushed together, and it is just to acknowledge this sort of strange covfefe that we're sort of dealing with here. We know that the Tax Cuts and Jobs Act temporarily doubled the original base exclusion of the applicable exclusion amount. So what it means is, at least federally, every person is entitled to $11.7 million of exclusion amount for gift or estate tax purposes and also for GST exempt purposes. Now, I break this down into the base exclusion. That's what we got with with the TRA 2012. We've got the bonus exclusion, which was put in by the Tax Cuts and Jobs Act. And we have to acknowledge, and we already know, that it is due to expire at the end of 2025. Now, there's been lots of talk, given sort of the change in Congress, that this bonus exclusion is likely to get cut short long before 2025. And so we're all scurrying around to use it up before we lose it. There's lots of talk of that maybe we'll even lose a portion of the base exclusion, going back to historical norms. 3.5 million is sort of the one that's been thrown out. What I want to concentrate on, without speculating in terms of what the future might bring, is the anti-clawback regulations. Now, we all know at this point, the anti-clawback regulations, which were authorized under 2001 G2, say that if you are lucky enough to use any portion of your bonus exclusion in a gift, by way of example, and you pass away, when that bonus exclusion is literally no longer in the code, in the calculation of your estate tax, you will not be penalized. That's essentially what they've said. So if I make an $11.7 million gift using up my base and my bonus exclusion, and I pass away, let's say in 2026, when there is no bonus exclusion in the calculation of the unified credit, which is the way to think about it, what it basically says is, in fixing the anti-clawback problem, we will go ahead and make it so that you are not deemed to have a phantom gift in your estate tax calculation, so that you don't get penalized. Now, here's the quirk, and here's the trickery. I call it the trickery that the IRS tried to push down on us, and it's this. The fix in the anti-clawback regulations, you will notice, is not in 2001. It was authorized in 2001, and we all thought they would, one, fix it, but two, that the fix would come in the form of 2001 adjustments. 2001 has to do with adjusted taxable gifts. Now, remember how the estate tax calculation goes. You start with the assets in the gross estate, and then you add back adjusted taxable gifts, getting to the sort of the tentative amount that you calculate the estate tax, getting to the tentative tax, and then on the following page of the 706, once you've determined the tentative tax, you then subtract out the credits. Now, why is it important to understand the adjusted taxable gifts versus the credit? It is because the anti-clawback regulation fix is not in adjusted taxable gifts. We thought it would be there. We thought that what it would say is, in the calculation of the estates tax, we would reduce your adjusted taxable gifts by the 5.85 you use of the bonus exclusion, except they put the fix in 2010, which is the unified credit. That's the following page of the 706. And so what the Treasury regulations basically say here is, effectively, if you use your bonus exclusion, thereby having more adjusted taxable gifts on the first side of the 706, and it gets calculated down, and so you end up with a higher gift estate tax liability as a result of the addition of what you gave away of the bonus exclusion. What it says is, we're going to increase the unified credit by just enough so that you don't get penalized for having effectively this phantom adjusted taxable gift in the calculation. So what is all of that gobbledygook? It is a two-sided coin here. There is the good side and there is the bad side. The bad side here is, by putting the fix and writing it the way that they did, they basically said, every person in the United States has been granted an additional $5.85 million of bonus exclusion to use during lifetime. However, the only way that each person can use any portion of their bonus is they have to be willing and able and financially capable of using up all of the base exclusion first before you can use any portion of your bonus exclusion. In other words, 99.8% or more of the United States has been granted a great gift exclusion of additional 5.85, but 99.8% of the world cannot afford to use it. The good side of the coin, we're going to discuss a little bit later on. By using this trickery, by pretending to give everybody this a wonderful thing that basically you can only use if you're willing to die while it's in existence, we're going to use that trickery against them, because the fix is in the unified credit, and there are ways to adjust on the adjusted taxable gift side so that you might be able to get not just $5.85 million of exclusion, But there is a way, under the current state of the law, that you can get 3 5.85 exclusions. So hold on, and we'll get into that. So with that as a background, we have to talk about Congress. Now, we all know the makeup of Congress at this point, not exactly a blue wave, but at least nominally or in theory, the Democrats hold voting control over Senate, House, and obviously in the White House. So what that means is everything's on the table. And so given that this is a Biden-Harris White House, let's just take a look at what the Biden campaign has proposed during the presidential election, and then go back to the previous administration when Biden was vice president with Obama and see what's in there. I'm not going to go into too much detail in here. You have these slides. You can read these slides. Let's understand directionally, income tax rates are likely to be much higher. Okay? Secondly, we'll talk about this in the other one. There is a chance that long-term capital gain tax rates will go up to much higher rates, to ordinary rates. Campaign Biden has proposed for those taxpayers with $1 million or more. And both Campaign Biden and Obama Biden believe in, quote, restoring historical norms on the transfer tax side. And if you're looking for what that might mean, you can look at the Obama Biden, and what they have sort of espoused is $3.5 million, $4.5 million transfer tax rate, and then the game changer, right? Eliminate the step up in basis, and we'll talk about that on the next slide. Maybe higher corporate tax rates, right? Maybe some limitations on the qualified business income deduction for pass-through entities. And then you can see on the bottom right-hand side a whole host of things that would limit many of the things that we are so used to. Zeroed out grats may be gone. Short-term zeroed out rolling grats may be gone. Taxable gifts of 25% or 500,000, whichever is greater. Dynasty trusts that last forever may be gone. 90-year limitation. This annual exclusion may be limited in some way. And then another one that I think is going to be a huge game changer, if in fact it comes away, not an elimination of the grantor trust rules, but the ability to do transactions with intentionally defective grantor trust, treating transactions or distributions or turning off of grantor trust status as transfer tax events, and then maybe, possibly, the elimination or the severe limitation on the unlimited like-kind exchange for real estate. Now, if I'm a betting person in terms of those things that are likely to become the Biden-Harris plan moving forward from a tax standpoint, I think directionally you are looking at higher income tax rates. I think there is a very high probability that you are going to return back earlier than later to a 39.6% highest income tax rate. Secondly, the 3.8% Medicare surcharge, the Obama surcharge for the Obama healthcare plan, that looks to be secure on top of that. I would say there is a very high probability that while you will get the SALT deductions back, thankfully, Oregon, New York, we're very happy about that. There is going to be the return of the PEAS limitations, and there is going to be a limit on the savings on itemized deductions to not 39.6 or whatever your rate happens to be. It will be limited to 28%. It is a huge revenue generator. Okay, we'll talk about the step up in basis in the capital gain tax thing in the next slide. On the corporate tax rate, while Campaign Biden has espoused a 28% tax rate because it was literally between the 21% and the 35% it was before, the 21% that Tax Cuts and Jobs Act put in and the 35% that it was before, what our government relations folks say, it is likely to settle in at 25, not at 28. And then I'll just sort of point out to you that there is very little chance that any of this will come in this year. And if it is going to come in this year, you'll hear about it starting in the at the beginning of the fall congressional session, not in the first half of this year. Most likely, any of these changes that would come out would be effective earliest January 1, 2022. And so let's take a look at the two possible game changers. Clearly, the increase in the capital gain tax would dramatically change many decisions here. Now, campaign Biden said 39.6 for those taxpayers with $1 million or more. This is all about the details, none of which are out there, right? How do you determine how that income is defined? What are offsets, if there are any? How are you going to define how the taxpayer is defined? Will you be able to do this with non-grantor trust and INGs, and spouses get their own $1 million of triggering? Is it a cliff or not? It does bring up the fact that we should be thinking about maybe we should recognize now and defer losses into the future because we can anticipate higher capital gain tax rates. And I show on this slide for you two things that you may want to consider here. One is installment sales with the ability to elect in or out of installment sale treatment the following taxable year. Now, because installment sales do not work on marketable securities, one other idea you might want to have, it's not nearly as flexible as the installment sale election is, but you can do a 1259 constructive sale, do a short sale against marketable securities, and if by the following taxable year, you decide that you don't want to trigger the gain because you're putting the short on this appreciated financial position, there is a closed sale exception that says by 1/30 of the following year, and so this slide should actually say 1/30/2022, you can undo the constructive sale and undo effectively from the sale the taxable event. Now, you can see any number of things that we will be thinking about if this capital gain tax proposal comes in some form in the future. Let's move on to the elimination of the step-up in basis. And let me just point out the one thing that my government folks have scared the heck out of me is if I were to handicap the probability of the elimination of the step-up in basis, I would have said there was about a 10, no more than 20% chance that this would happen. My government affairs folks say it's a huge revenue generator, and it primarily benefits the most the 0.2% of the world. This is higher than you think it is. It's not to say that it's a greater than 50% chance, but it is. It's got a puncher's chance, for another sports analogy. Well, obviously, we'll have to figure out what elimination means. Is it pure carryover basis? Is it modified carryover basis like we had in 2010? Or is it a taxable event at death like we have in Canada, right? Things to be looking for there. What are the exceptions going to be for closely held businesses, real estate developers? Let me just point out to you, if you have pure carryover basis and you have negative capital accounts, or what some people call negative basis, okay, which is very common with real estate developer holdings, pure carryover basis under the current set of the rules will trigger all of that gain at death. Finally, in terms of the only response I can think of from a planning standpoint, if this comes into existence in some form, I know we have a few life insurance folks on the call, is life insurance. what other thing is going to provide liquidity to help defray the tax costs at a time when you have an unanticipated death and you have unanticipated liability? So there's a question. Yesterday's speaker indicated removing the SALT deduction cap might be difficult as well as to need revenue. You said you foresee it's likely going away. Clearly, it's still a toss-up on what will happen. Do you anticipate we'll see states continuing moving forward workarounds, and have you seen any of that work or work well? So Joylene, I'm of the camp that the Biden-Harris administration will push through the reintroduction of the SALT deductions, but then they're going to put a cap in the 28% itemized deductions. And so we'll get it back. We'll probably have a reinstatement of the Pease amendment. So the 2% of AGI is going to cut out the bottom small percentage of it. Then you're going to be able to take it, but then the amount of savings you'll get is going to be lower than if you are in the 39.6% tax bracket. And I think a lot of that has to do with, it was the perception is that the Trump administration put in the SALT elimination as a poking in the eye of the high income tax states like Oregon and New York, which tend to be Democratic states. And so it was sort of a political move more than anything else. And I understand that it is a revenue generator without questions, but you can generate revenue by putting in the caps and putting in the Pease eliminations and provide a little bit more equity between those states that are paying, where you are paying high state taxes versus those like Texas or Florida, red states that you don't have, by way of example, state income tax. And so there has been talk this year of reinstating some of the workarounds. So New Jersey has put a proposal together. The representatives of New Jersey have put a proposal together. Again, I think that ends up being a non-starter with a more permanent fix rather than a workaround. And I guess there's a chance there might be a workaround maybe this year where they get rid of the IRS limitations on the workarounds that you have this year if you're not able to make any of those particular types of changes. Again, I'll throw in here, many of these changes can be made in the budget reconciliation process. Let's remind ourselves, Tax Cuts and Jobs Act, which was one of the biggest changes in the tax law in recent history, was actually done through the budget reconciliation process. And so I think there is a chance that you might be able to have the reinstatement of the SALT deductions this year, notwithstanding the fact that it seems like the vast majority of the changes are likely to happen and be effective next year. Now, hopefully that answers your question. So, can you feel the burn? Because he's burning for you, or at least he's burning for your clients. Now, here's a couple of things to consider. Bernie Sanders, because he is one of the Democratic senators that can't simply just be put into the administration, because then you would lose a positive single vote in the Senate, and then leave yourself to the vagaries of what the Vermont governor is going to do in terms of replacing him in the Senate. He's not going anywhere. He will be in the Senate. He has just been put in charge of put on the budget committee. And because of that, and because he can't simply be put and thanked for his support by being put in the administration, at least in this version of the administration, if they get reelected, maybe in the next administration, he's going to have more sway in terms of what might be coming down the line. And so you have to dust off from 2019 for the 99.8% Act out there. And so I've pulled 5 things really having to do with the income tax, really having to do with the estate tax that are now suddenly back on the table. And so you can see on the top line here, we might be returning to transfer tax rates At 55, for those of our clients who have 50 million to $1 billion, and for those of us who are lucky enough to have billion-dollar clients, 77%. What seems very clear to me in terms of the plurality of the ideas out there, it is a reduction of the applicable exclusion amount, although I personally think they're going to end up at the base exclusion that we have today, maybe stopping the inflation adjustment. That seems reasonable to me, that rather than taking away exemptions that people already have. But reasonable minds have been wrong 100% of the time over the last 4 years and change. I think you are going to have a return back to the attack on valuation discounts. Now, whether that is a return back to putting back on the table the proposed regulations in under 2704, or this proposal that is in the 99.8% Act, no valuation deductions on entities holding non-business assets, and the elimination of minority discounts on family-controlled businesses. This is a really, what you need to understand is this thing is already written. It's already written in a bill. I think it's Senate 906 or 609 or something like that. And so it's very easy to just sort of throw this one in here. Clearly, grants are on the table. Same thing with the intentionally defective grantor trust from the Obama-Biden Green Book. And even more GST limitations are being proposed by this act, 50 years rather than 90 years. And so this is sort of what I think we need to worry about in making the decisions that we have today. So with that, let me just say, under the current state of the law, this is the way I think about our client base. Those clients who never have an estate planning problem, it's like we had before the increase. Don't make any large taxable gifts. Keep all of your applicable exclusion, benefit from the step up in basis, and let's hope we have it. For the ultra wealthy, use up your base and your bonus. You can afford it, valuation deductions, avoid estate tax as much as possible. And then we have the middle class wealthy, which is the plurality of our clients, right? They're wealthy. They have an estate tax problem, but they're not so wealthy that it's so easy to just give away the base and the bonus without retaining flexibility and retaining the ability to get at those assets. And so with that, let's jump into some of the planning ideas that I think should be at the forefront of everybody's minds. First and foremost, at a time when we don't know if there's going to be a reduction, if it might be retroactive, which I think there's very little chance of that, but it's still a possibility. How do we undo taxable gifts that we make this year? Okay? If it's decided that it's better to not have done it this year. My favorite one, so you can see across the top and you can read this on your own. There's lots of reasons why you may want to undo a taxable gift. One might be your client passes away soon after making the gift, and you still have all of your exclusion, and you want the step up in basis, right? For different types of situations, for most situations, I would say my favorite one is the disclaimer trust. And it is simply a trust that says, I make a gift today, but the provisions of the trust specifically say one particular beneficiary has the right on behalf of everybody who is a beneficiary or has any beneficial or contingent interest in the trust to disclaim the interest that he or she has on behalf of everybody. And if they disclaim within 9 months, it is a qualified disclaimer and it literally returns back to the donor. It allows the donor to effectively undo the taxable gift, get a step up in basis if that's what you're trying to accomplish, and it literally erases itself off the face of this earth. The other one that lots of people have been using, and sometimes they use it in conjunction with a disclaimer and a Q-tip trust combined together. Too much time to describe how that works, is the Q-tip trust. If you have a spouse, you fund a trust that has all of the provisions of a qualified terminable interest property trust under 2523. And then the following year, on the next gift tax return, you can either elect Q-tip trust status, which it literally means it's no longer a taxable gift. It's a taxable gift, but it's fully covered by the marital deduction. And so you don't have a net taxable gift that uses up the exclusion, or you want to lock that gift in. And so you elect out of Q-tip status. I think these are my two favorite things to do to literally undo the gift. Okay? So, of course, you all are thinking of spousal lifetime access trust. I'm not going to bore you with it. I just want to give you 2 practice points about spousal lifetime access trusts. I know what you're thinking, that the name of the game here is I create a trust for a spouse creates a trust for me, if I had a spouse, and while we're both alive, we both have access to all of the assets. If the other spouse dies first, then I can rely on the exercise of a power of appointment to send it back to me as the original grantor, so that even though I gave it away, I now have it in trust for me. And the hope is that those assets are not includable in my estate, and I've effectively kept access to all assets, all of the $11.7 million. The practice points I want you to know here are: look at state law and determine what state law applies to your trust. And the reason why state law is important is you need to look at the creditor claims provisions. Under the vast majority of the states, if you create a trust for somebody and they exercise a power of appointment to return those assets to you in trust, and you are the beneficiary of the trust, the vast majority of the states say those assets in trust for you are included in your estate for estate tax purposes because creditors can get at those assets. And so what you are looking for is a state-specific overturn of that provision. In other words, it says, even if it returns back to you, even if you are the original grantor of those assets, creditors of yours cannot get at those assets. And so, as I said, the vast majority of the states still have the common law. I believe the last time I tried to look for this, Oregon did not have that provision, but you're trying to find a negative or prove a negative. Somebody can tell me whether or not they have or don't have it if they've looked at that in the chat. That means you need to go to another state in order to play this game. The only 2 states that I know have these provisions are Texas and Delaware. Both of them specifically undo this. Secondly, reciprocal trust doctrine. The 2 poll stars here are Grace and Levy. Let me give you my favorite way to abrogate the reciprocal trust doctrine. And it is as simple as this. Create a trust for spouse number 1. Make spouse number 1 immediately a discretionary beneficiary. Spouse number 1 creates a trust for spouse number 2, but spouse number 2 is not a current beneficiary. But spouse number 2 becomes a current beneficiary if spouse number 1 dies first. The reason why I love the elegance of that particular change to abrogate the reciprocal trust doctrine is because you have to remember the reciprocal trust doctrine is determined at the time that these are funded. And at the time that these are funded, one big fact remains. One spouse is a beneficiary of one, the other spouse is not. Okay, with that, let's move on to, let's walk before we run. We have near historically low AFRs. I know you all are thinking about or have already refinanced every promissory note, every installment sale. If you haven't done it, do it now. One practice point I want to throw out to you. Remember, you cannot have on your refinancing a term that is greater than the life expectancy of the holder of your note or installment note. And the reason for it is private annuities. Whether the IRS is correct or not, they still take the position that if the term is greater than life expectancy, it is not debt. It is akin to a private annuity, and the private annuity rules apply here. Now, you would think, well, that's fine. Private annuities are 75-20 vehicles, and the 75-20 rate is 0.6, and the long-term AFR is 1.45. We win. We even have a better interest rate on that deal. All of which is true, except my guess is the vast majority of your notes and installment notes are to grantor trusts. Grantor trusts that are intentionally defective grantor trusts. If it is, intentionally defective grantor trusts are considered private funds for private annuity purposes. And if it is a private limited fund for private equity purposes, for private annuity purposes, you have to remember something, the 110-year exhaustion test. And the 110-year exhaustion test says, unless you are greatly capitalized in the intentionally defective grantor trust already at the time that you do the refinancing of the note or the installment note, you have to solve the 110-year exhaustion test, which assumes that you need to have the assets in order to pay everything that you're supposed to pay for assuming that somebody lives to 110 years of age, but assuming that the assets only grow by 0.6%. You will fail this. That means you will have a taxable gift of what you think is a non-taxable refinancing. Skip past that. Let's get into the 75-20 vehicles here, because I want to get past this stuff to get to the last thing I want to end with. 75-20 vehicles, of course, we know it is near historically low. It bottomed out in November of last year, but it stayed close to 0.4%. Now, we all know the most popular 75-20 vehicle is the GRAT. For those of you that I have known, and many of you I think I have known for over 20 years at this point, you may recall 20 years ago, I wrote about zeroed out rolling GRATs with highly volatile assets. And so you would think with the stock market as volatile as it is today, that, and with the 75-20 rate of 0.6%, that I'd be going back, dusting off that old material and going back to zeroed out rolling GRATs. And the answer is I'm exactly the opposite of that. Let me pull out something that I talked about 4 years ago, and that is the 365-year GRAT. Now, one practice point here. You cannot do this in Oregon. You have a rule against perpetuities. You can't have a 100 or 360-year GRAT, 365-year GRAT. But you can go to Nevada, which has a 365-year rule against perpetuities. And if you really want to push the pedal to the metal, go to Utah, which has a 1,000-year rule against perpetuities. Why would I go out that long, ensuring that I'm going to have something includable during the time that my client will die during that term? And it is because we have to remember that the amount includable in a GRAT is not simply the fair market value of the assets. It is the lesser of the fair market value of the assets, or if it is less, the amount of principal to pay the annuity in perpetuity. And in the math that you need to know, here's the equation. You take the annuity payment that you retained, you divide it by the then prevailing 75-20 rate at death. So let's just go, because let's be provocative. Look at the 365-year GRAT numbers. If you put $10 million into a 365-year term GRAT, at today's 75-20 rate, you need to retain a $67,000 annuity in order to zero out that gift, right? So what have you done? you have guaranteed during the remainder of your client's lifetime a $67,000 annuity effectively for a lifetime. And when they pass away, the amount includable in the estate is the lesser of the fair market value of the assets, whatever that happens to be in the future, or the 75/20 rate will drive it. And you can see here, because the annuity payment is fixed, the 75/20 rate is the thing that you need to figure out. If the 75/20 rate is 1%, the amount includable is 6.7%. If the 75/20 rate is 3, by the way, the long-term median is 5%, it is $2.3 million. Think about that. If the asset that you put in here was municipal bonds and it had an anemic 0.676 coupon payment on something that would stay at $10 million and would not be entitled to valuation discounts, when your client passed away, not only would they be able to keep the coupon for the rest of their lifetime, the amount includable at a 3% 75/20 rate is 2.3%, which is a 77% discount on an asset that would not have any valuation discounts. And the value might be much higher. You can see what the value would be over time, assuming a particular rate of return here. 2 practice points here. In order to zero this out, you have to make sure that the ongoing annuity payments continue on after the annuitant dies. That's the only way to zero out the gift. However, nobody wants to keep this open for another 275 years. So you have to think about ways to collapsing this after your client passes away and get rid of it so you don't have to deal with it. And the answer here in my mind is known as merger. In your technical materials, I discuss this in the form of a question. You will get it. I just don't want to proactively write about it. Secondly, the other practice point to understand here is nobody knows if the amount includable is 2.2 or 2.3. Does that mean the assets in the graph have to be stepped down to 2.3? Maybe. So it got me to thinking. What's the best asset to ensure that you have return, and a return of an asset type, so that you will never have the question of a step down in basis? And I realized it's cash. And then I realized that the perfect thing to put into long-term grats is life insurance. And then I realized that this idea is in fact the perfect private split dollar life insurance alternative. You give $10 million to the long-term grad, the long-term grad buys life insurance, has to pay as if it were paying a promissory note in a private split dollar arrangement under the debt regime, 0.67%. That is fully more than half of what the long-term AFR is. And then when your client passes away, they don't have a note includable in their estate at all. Nothing. The amount includable in the estate is $2.3 million, which is a 7% discount off of a note that otherwise would not have gotten that type of discount. And you guarantee your IRR coming in at death. Let's say it's $50 million of death benefit, and no question about whether or not there's a step down, because it's always going to have a $50 million basis. This is a great place to put all of your installment notes, by the way, so they're not includable at face value and you don't have to argue with them. They're out of the estate. Here's the calculation for estate tax. And this is the best thing to be thinking about when, even if you're not planning on putting anything other than cash in this or whatever, this is the best thing to fund, maybe with a promissory note, at a time when grats may be abolished, zeroed out grats are abolished. This is the thing you put on the shelf, available for future years, because it falls out from under the intentionally defective grantor trust proposals as currently written. And so you put this on the shelf, and when they get rid of zeroed out grats, you pull this one back out, and then you start supercharging it. Okay? You don't have to go out 100 or 365 years. The numbers are incredibly great, even at 50, 60, or 70. And by going out for a shorter period of time, from an optics standpoint, it looks a lot better from an audit standpoint, although you can totally do this now. And secondly, you might want to retain more cash flow for your clients. You can see significantly more cash flow retained for lifetime. And at a time when you're looking for ways to use up your bonus exclusion, but still not get rid of all of the assets from an economic standpoint, why not make it a taxable gift, putting $10 million in, but retaining only a $4.15 million retained interest, creating a $5.85 million taxable gift. These numbers are on par with or better than the 100-year zeroed out GRAT. Do it now. Do it when you can. Do it with a promissory note that you can pay off or swap for other assets. Let me dust off another thing that I used to talk about, the shark fin clat or backloaded annuity clat, the intentionally defective estate transfer clat. The remainder goes to the kids. It's a grantor trust. Here are the benefits. First, generate an income tax deduction to your client. GRAT doesn't do that. Make payments to charity. Save the world. A GRAT doesn't do that. Third, no mortality risk at all. If your client dies during the term of your CLAD, nothing is includable in the estate. Going to the same beneficiaries, and then unlike a CLAD, unlike a GRAT, take advantage of 2007-45, backload the annuity payments, all of these annuity payments, taking that $10 million example, zero out the $10 million contribution. You can have level payments. You can increase them like a GRAT, 20% per year. You can increase them by 50%. That is the most common. By the way, that is the one that I recommend. All of it is in your materials, why I recommend that one. Or you can do something that I think is allowable. I don't necessarily recommend it, the shark fin. Small payment of $1,000, one single payment at the end of $11.25 million, like a zeroed out balloon note, hence the other name of this thing called the balloon clat. Why do you do this? It allows you to survive down markets if you're investing in the capital markets. It keeps more assets in the clat, and the more assets you have growing more than 0.6%, it's of no surprise that the more you backload and the more you return, the more free remainder interest you end up with to the children in blue. Whether or not you have 3, 5, or 7%, the more you backload, the more free wealth transfer you end up with. The 50% increase in the shark fin numbers are much better than the other ones, but I just want to point out the 50% increase in the shark fin are basically the same. So why not just go with the 50% increase? And by the way, there is an income tax benefit of going with the 50% increase if your client dies during the term and your grantor clat converts into a non-grantor taxable clat. And with that, let's end with the last 75-20 rate vehicle, private annuities. You already know if you're going to do a sale to an IGIT, you have the 110-year exhaustion test. Well, this is where the bonus exclusion comes in. Why not make a gift of, let's say, $10 million? Why not make a gift of first $5.85 million of your bonus exclusion? Sell an additional whatever amount, $4.15 million back to yourself under the private annuity rules. Okay? What are the benefits here? One, the exhaustion test is met. You have all of the cushion you need in the form of the bonus exclusion. Secondly, this is a zeroed out transfer of assets because it's a gift and a sale. Third, you lock in 0.6% as the hurdle rate. Fourth, unlike a GRAT and unlike a CLAT, you can customize the retained annuity anytime, any way you want. You can have a fixed payment, you can have annual increases, you can skip payments, any payment for any number of years. All of these annuity patterns satisfy the private annuity rules. And so depending on your client's situation, you can have any of these work for your clients depending on their situation. And then finally, in the last few minutes that we have before we go to Q&A, let's talk about non-qualified, other people call them intentionally busted, preferred partnerships. We know what a preferred partnership basically does. You have a client, he or she puts in a bunch of assets and then takes back two different types of economic return from those assets. One, think about it as a bond. The other one is think about it as a growth stock that never pays a dividend. Like the bond, which is the preferred interest, it has a par value. In preferred words, this is the liquidation preference. This is the money you get back when everything is done. You get the first liquidation amount equal to a fixed dollar amount. And like a bond, you are entitled to a coupon, which is a percentage against the par value. Here, the coupon is a preferred payment at a fixed rate against the liquidation preference, like 6, 7, or 8%. And the common holder, like the growth bond, is entitled to everything else over and above in the future, separate and apart from the liquidation preference, which is fixed, and the annual payment right of this fixed dollar amount, the coupon. Okay? So with that as a background, here's the example I want you to run with. Given today where we are, think about the following example. It doesn't have to be exactly this, could actually be larger, but this makes the point. Your client puts into a limited liability company $11.7 million of assets and splits the economic ownership that he or she takes back exactly into 5.85 of preferred, 5.85 of common, and the preferred has a coupon current rate of 6, which is close to what it is today. That equals a payable right of $351,000 every single year off of the $11.7 million. Practice points here. You want this to be an LLC. You want the grantor to take everything back because you want this to always be a disregarded entity. Second practice point. This entitles your client for the rest of their life, assuming they hold on to the preferred for life, they have the right to receive $351,000 every single year. Great payment right for people who might be worried they might run out of money. Secondly, you make sure that when you transfer the common in a gift, you gift it to an intentionally defective grantor trust. This all is a disregarded entity. You don't have to worry about anything in subchapter K. Okay, what's the value of the gift that you've made? Well, it depends on two things. It depends on the subtraction method under 2701, and it depends on whether or not this is a qualified payment or not. Now, I've told you, I want this to be a non-qualified payment. But to know what a non-qualified payment, we need to know what a qualified payment is. So let me make the subtraction method easy for you. Step number one, this is a simplification, but step number one is $11.7 million. Step number two, you get to subtract out either zero or the value of a qualified payment interest right, which is defined as, on the right, an annual cumulative payment paid at a fixed rate. Okay? We want this to be non-qualified. So the one I want you to think about not having as in your documents is the cumulative one. I want you to make this a non-cumulative payment. Now, what do I mean by non-cumulative? What I mean is if you are entitled to $351,000 every single year, and in the first year, you only receive $100,000, a cumulative payment would mean that in the following year, they would have the obligation to pay $351,000 plus another $251,000 if you have enough profits. And if you don't have enough profits for all of that, the obligation goes to the next year and the next year. In other words, you have this cumulative aggregate obligation to make sure that in aggregate, you pay out $351,000 every year. Don't do that. Make it non-cumulative, which means in step number 2, it's 0. Step number 3 says, take that 11.7 minus 0, which is now 11.7, and then allocate it among the transferred interest, which is the 1/2 interest, which is the common interest. Now, forget about those discounts. You get them, but just forget about it. I want to make this easy. What that means is in step number 4, you have $11.7 million to allocate to the common interest, and that's it. Wait, let me see if I get this right. I gave away half, all of the common interest, but it's half of this partnership, and I'm ending up with an $11.7 million gift. But don't I still own the preferred interest, this non-cumulative preferred? Yes. And that's the magic of turning the trickery on the anti-clawback regulations on its head and against the IRS. What do I mean by that? On this slide, forget about the top portion of this slide. Only look at the bottom portion of this slide. On the left-hand part of the slide are the estate tax consequences. On the right-hand part of the slide are the gift tax consequences. Okay? Remember what we did. We made this preferred interest a non-qualified preferred interest. By making it a non-qualified preferred interest, on the gift tax side of the equation, the bottom right-hand part of this slide, remember what the result here is. 11.7 minus 0. We ended up this year, by doing this transfer this year, with an $11.7 million gift that uses up the base exclusion of 5.85 and the bonus exclusion of an additional 5.85. We ended up with a phantom gift that nonetheless uses up the bonus exclusion. It's still a taxable gift. Aha, but let's remember one thing importantly. We have a preferred interest that is includable in the estate. The preferred interest has a $5.85 million liquidation preference. And we have put in the document that there is an automatic liquidation of the 5.85 preferred interest at death. In other words, we peg the value to exactly the liquidation preference on the preferred. By the way, by design, it also equals the 5.85, a phantom gift that used up the bonus exclusion. These two things you want to be in parity. Remember, these are within your control as a planner. Your coupon was determined by the then prevailing rate. And if it's the then prevailing rate, it means that the zero value phantom gift is exactly equal to the liquidation preference. You're making sure that the estate tax amount is included in the estate at the liquidation preference with the liquidation force out. Okay? Okay, you've got 5.85 included in the estate. You used up the bonus exclusion. And so first thing you say here is, aha, I have 5.85 included in the estate, in the gross estate, first number at the top of the 706. But I have the anti-clawback regulations. And yes, you do. The anti-clawback regulations say you used up your bonus exclusion, but we're going to increase the unified credit by just enough, by exactly 5.85, which is the amount of the bonus exclusion that you use, which is exactly equal to the 5.85 that is included in the estate, in the gross estate. Great. I have zeroed out the inclusion of the preferred interest. I'm golden. And I'm saying, you're more than golden. And I don't know what more than golden is. You're platinum. Why are you platinum? Because separate and apart from the anti-clawback fix in the unified credit, because you did a non-qualified preferred interest transfer that was triggered under 2701, you are entitled to an additional adjustment. What is that adjustment? That adjustment is under 25-2701-5A. This adjustment basically says, if you ever have a transfer of a common interest that triggers the zero valuation rule, which you did, this is a non-cumulative, non-qualified preferred interest, we're going to make it up to you. And they make it up in two ways. We'll discuss the first one here, and then I'll discuss the second one as my last point. The first one here is, if you die with this preferred interest included in your estate, this preferred interest that triggered the phantom gift of 5.85, we will give you a downward adjustment in adjusted taxable gifts. That's line number 2 on the 706. We will have a reduction down of adjusted taxable gifts equal to the lesser of the phantom gift, 5.85, or the fair market value for estate tax purposes of the interest that is included in your estate. That's 5.852 because you're liquidating it at death. So in other words, both of those are the same, which means the adjusted taxable gifts go down by 5.8 exactly. So what it means is, in the estate tax calculation, not only do you get a 5.85 reduction of adjusted taxable gifts, you are entitled to your base exclusion in the form of the base unified credit. You are also entitled to the anti-clawback increase of the unified credit, which is another $5.85 million of assets that otherwise would have been subject to estate taxes, which means this thing, under the current state of the law, gives you three $5.85 million of effectively exclusion. You've tripled what you only thought you had two. The couple of things that I will mention to you before I get to the last point here is, you can't lose on this calculation. Even if the anti-clawback regulations put in anti-abuse provisions, which they said they might do in the preamble, you still get this adjustment. And if you only get one or the other, you still zero out. More importantly, not only do you get to zero out, from a practical standpoint, what have you given your client? You have given your client optionality to take $351,000 or not every single year. Think about this. If in the first year the client says, I'll take the first $100,000, fine, here's $100,000. the unpaid amount of $251,000 doesn't have to be made up. Next year, you can take zero. The following year, you can take all $351,000. Optionality, flexibility, possibility of 3 exclusions. Now, last point I'll make before I get to Dan Monahan's question is this. There's another adjustment, and it has to do with the gift tax. Okay? What it says is if you created a phantom gift under 2701 and you gift the interest before you pass away, you get the same adjustment in adjusted taxable gifts on the gift tax return. It is the lesser of the value of the gift and the amount of the phantom gift, the 5.85. Now, why is that important? It's important because the current state of the law says you can get 3 exclusions. However, you might have anti-clawback regulations and anti-abuse provisions that get rid of the 3. Although, by the way they talk about it, it actually doesn't get rid of this problem the way they said they're going to look at it. If you're worried about them and you really want to get 3, gift it away. If your client can afford it, just gift it away. Gifting it away this year locks in the taxable gift, locks in the adjustment for gift tax purposes now before they can take away your 3 exclusions. So the question from Dan Monahan is, Paul, how does this look if the estate tax exemption goes down to $3.5 million? Again, this is prognostication, but the way that I sort of, I'm going to stop the screen share. The way that this works, based on my reading of the, anti-clawback regulations, the anti-clawback regulations would fix this problem. If it goes down to 3.5, for those people who have not used any of the base exclusion above 3.5, they'll just have 3.5. For those who have made gifts greater than 3.5, not grown with inflation, you'll essentially get the anti-clawback fix over and above that. One additional question that came up, can you talk about grantor ILETs entering into a low basis asset purchase using AFR rates for interest and then using ILET assets from purchased property to pay for asset sale at the end of the term? What about using life insurance within the ILET with premiums paid or with transferred property? John Thomas, I'm not really sure if you're talking about, then using ILET assets from purchased property to pay for assets at the end of the term. All of that is fine. It's just, John, shoot me an email. I'm not really sure given the limited amount of time. I guess we've got about 5 minutes. Let me see. John, can you write in there? Are you talking about after the life insurance has matured? In other words, the assets, the death benefit has come in and you're buying assets from the estate, which is what you typically have. But if you're saying, can you buy other assets? Of course you can. With premiums paid for the transfer property. Premiums paid for the, what about using life insurance within the ILET with premiums paid for the transfer property? Again, I'm not really sure what the question is, but if you are talking about having put premiums into a life insurance policy that has not matured and you haven't gotten the death benefit, but you have, you have the account within the life insurance policy, obviously you can make distributions up to basis and then borrow against any additional cash value in order to free up tax-free income in order to buy other property without question. And John, if I haven't answered that question, just shoot me an email and I'm happy to to answer your question. That gives us all of 4 minutes. If there are any additional questions or comments, it's wonderful to see everybody. If you don't, and I sure hope to see you all soon in the near future if you'll have me back. Thank you very much for your time.
Thank you, Paul, for kicking off this Friday with a wonderful presentation. I'm Ted Austin, Senior Vice President and Market Leader for U.S. Bank's Private Wealth Management Group. And once again this year, we are thrilled to be one of your gold sponsors. Most years, I'd stand in front of you right now and tell you how wonderful it was to see everybody, to make the connections with friends and old colleagues that we don't see as much anymore, and that in many cases, we only see this one time of year. Alas, this is not happening this year. I'm coming to you pre-recorded from my home office, but look forward to seeing everybody and rekindling those connections when we get together again next year. I'm very pleased to introduce our next speaker, Raj Malviya. Mr. Malviya has been practicing law since 2005. His legal and tax practice is focused on estate and tax planning and asset protection for individuals and organizations, with a subspecialty of handling estate and tax planning for international-based families living in the U.S. and U.S. families living abroad who have foreign connections. As part of the private client practice, Mr. Malviya is versed in the formation, planning, and governance associated with domestic and foreign charitable and tax-exempt organizations. He is also versed in all aspects of estate and trust administration, including tax, compliance, and information reporting related to private client matters. Mr. Malvaya is recognized by Best Lawyers in America for Trust and Estates Law, as well as Tax Law. In 2019 and 2020, he was also voted the Best Lawyer in America as Lawyer of the Year in his geographic area of practice for Tax Law and Trust and Estates. He's been selected for inclusion in Super Lawyers, Michigan Rising Stars for Estate Planning and Probate from 2008 to 2020. Mr. Malvaya regularly speaks and publishes statewide and locally on a variety of tax and estate planning topics. Recently, speaking and writing engagements have been for the American College of Trust and Estate Counsel, the American Bar Association, the Heckerling Institute on Estate Planning, Notre Dame Tax Institute, and Michigan Continuing Legal Education. Today, he will be speaking on the topic of New Year's resolutions on drafting trusts. 10 landmines you don't want to plant. Thank you, and let's give a warm Portland welcome to Raj Malvaya.
Good morning, everyone, and good afternoon here in Michigan, in cold, snowy Michigan, where we're experiencing currently a severe ice and winter storm. So I'm fortunate that I was able to connect with you today. Our internet connection has not gone down, and I'm able to be with you. A couple of quick house cleaning items. That was a really nice introduction from Ted. It was unnecessary. I'm sorry it had to take a few minutes of the time here because we have a very meaty presentation that I want to get through completely. Number one, I hope you're all staying safe. We are here in Michigan. I, as you can see, have not gotten a haircut in many months. So I'm sorry if I remind you of a band member of the Moody Blues or from an 80s sitcom. I also want to just mention I've submitted a very technical outline that I'm not intending to refer to during this presentation. This PowerPoint has about 26 slides. We're going to get through all of them, and it's going to be just a potpourri of topics. So we're going to keep it moving very quickly, but I will do my best to try and answer questions at the end. And given some of the questions might be technical or require some background or more facts, feel free to reach out to me separately anytime. My email is in the materials, and we can set up a time to chat. So again, thanks for the introduction. My topic, as Ted mentioned, is our New Year's resolutions on drafting trusts. A little bit of context. When I was first approached to speak for this seminar, I was asked to talk about living trusts. And I thought that given the sophistication of this audience, we all know about living trusts. We know about probate avoidance and planning using living trusts. So I thought, what if we could really focus this and maybe even laser focus it a little bit on a topic that I think would be helpful and practical for all of you. Whether you're a CPA, a wealth advisor, a strategist, an estate planning or trust attorney, a tax lawyer, I think all of these landmines that we're going to talk about will be helpful for you, and hopefully ones that you'll not make the mistake of planning once we get through them. So if we could get started, let's go to the next slide, please. I have my colleague Anka is helping me with the slides. So every time I say next slide, we're going to just transition. So again, we know what the overview of this presentation is. This is really the structure of what we're going to talk about. And we're really going to focus on here, number 3, the problems or AKA landmines that we want to avoid when we're drafting living trusts. And, later on in the presentation, I wasn't trying to be cute. I just wanted to provide a definition of the word landmine. But we all know what a landmine is. It's something that really is unknown. It's hidden. It's underground, and it could go off at any time. And that's exactly what we're trying to avoid. We're trying to avoid certain features or problems or issues in our trusts that we draft, so that when it's time to administer them after the grantor settlor dies and the trust becomes irrevocable, that we don't have to deal with this problem. And I've chosen 10 that I think, some are more common than others, but definitely they're going to, I think, be ones that have hit your desk at some point or another. Next slide, please. So we don't need to spend time on, what is the purpose of revocable living trust. We all know what we like to use them for. I think we're talking about the core estate planning vehicle of a client's estate plan. We're not talking about the intentional irrevocable trusts we're setting up, whether those are statutory split interest trusts or irrevocable generational or gift trusts. We're not talking about those types of trusts where we're making completed transfers. We're talking about the kind we draft all the time, the standard plain Jane revocable living trust, also known as an inter vivos trust, a living trust, a revocable trust, and that's going to be the focus for today. Next slide, please. So, on a couple of these slides here, just trying to hit home on why we use living trusts, and this is really in foreshadowing some of the issues we're going to get in today. Sure, probate avoidance, property management, but as you've heard from the intro, I have a tax background. That's kind of the person that I am. I don't really have a lot of friends. I don't have a lot of hobbies. I really enjoy tax law and kind of threading the needle through those rules. And so, my practice really focuses more on some of those technical issues. And so a lot of the landmines we're going to talk about today have to deal with something related to a tax rule. But we use living trusts for transfer tax management. We also use living trusts for income tax management. If we're trying to create basis step up or leave flexibility for basis step up, perhaps in a surviving spouse state. We know we use living trust for children or grandchildren or loved ones or other beneficiaries of the trust. We use trust to protect from disinheritance if we're in a second marriage or a very sensitive type of marital situation. Changing circumstances, right? Tax laws change, rules change. We have to draft flexibility in our trust and so that it's adaptable to the ever-changing world that we're in. Next slide, please. So here's my definition. Again, not trying to be cute, but this is what we see when we're planning landmines as directors or advisors. It's doing something in the trust, whether most likely unintentionally, where if the trust becomes irrevocable and we're kind of stuck with the language that we have in the trust, we're going to be out of luck. We might have a consequence that we don't want that has been unintended, and it can have some pretty significant consequences and remove some flexibility that we may want in the planning. So let's dive in. Next slide, please. So landmine number one, and I've just got a couple notes too in front of me that I just want to make sure I hit on as I was going through this last night. So this, I think, is a very common problem, actually. If I'm reviewing trusts that I've seen that maybe I haven't done, or I'm getting involved in a certain trust situation in the trust holder trust, or maybe it just wasn't thought through carefully. The problem we have when we're drafting trusts that have estate tax planning is we're using formulas, right, to create a marital type of trust, assuming the client's married, and then a family type of trust to absorb transfer tax exemption, estate tax exemption. And there's a lot of different types of formulas and ways to do that. And a friend of mine who I appreciate got me involved in the opportunity to speak, Josh Husbands, who's very involved. He's with Holland and Knight in Portland, very involved with the Portland Estate Planning Council, has an excellent paper on trust funding formulas that I've cited to in my materials. But, the key takeaway I want to raise here, and the landmine that it really relates to, is, not being aware that when you're using pecuniary formulas to fund a certain trust, whether it's a marital trust or the family trust. So we're not talking about fractional share formulas. We're talking about pecuniary formulas where we're using a certain amount, fixed amount based on a formula. We have to be careful, because what that does is there's a potential recognition of gain that could happen under the 661 regs that is measured between date of death and date of funding. So you have a donation trust, the settlor guys, we're getting ready to fund the marital trust or the family trust. Most likely, if you're working wealth who isn't going to be subject to, may not be subject to estate tax, or the family trust is going to be the larger of the two trusts. You're typically using a pecuniary lead to the marital trust. But in those situations, timing is important, because if there's appreciation between date of death to funding, there's a potential income tax recognition event to the administration trust. And so then the residuary trust is going to bear the burden of that income tax, capital gain tax, assuming we're talking about a capital asset. So we need to understand the implications. We have to inform the client, and we have to draft accordingly. Think through our formulas. Are we sure we want to use this? Are we confident we can do funding as soon as we can if we're not using a fractional share type of formula? And draft for flexibility in your trust. Draft for a pick and choose type of situation where maybe the fiduciary or the trustee can choose certain assets to satisfy that pecuniary amount, so we can maybe attempt to minimize some capital gain that's recognized. So those are all important things to keep in mind when drafting funding formulas. Next slide, please. Number 2, I think there's sometimes a fusion when a practitioner is using a Clayton style type of Q-tip versus a disclaimer type of trust. And, importantly, these are trusts that are used for a similar purpose. We're trying to have post-mortem flexibility because we don't know what estate tax exemptions are going to be when the grantor or settlor dies. And that's the case. We saw a lot of this plan in 2012. We're going to see a lot of it now, right? And we're trying to have flexibility so that when grantor or settlor dies, we're not exactly sure what's going to be in the gross estate. We're not sure what the exemption amount is going to be. So we have some flexibility. We can send everything to the surviving spouse in trust with the opportunity for the surviving spouse to disclaim. And then if there's a disclaimer, the disclaimed assets go into a disclaimer trust for the benefit of the other beneficiaries and the spouse. Perfectly fine type of flexible plan. But we have those issues, right? Those timing issues and those control issues. Is the surviving spouse going to really do this? Are we going to stay on top of it and make sure that the surviving spouse is aware of this disclaimer that needs to be done? And it has to be qualified, right? We know qualified means done within 9 months from death. So we have to docket that and make sure that happens. Those are tricky timing issues, the control issues. And we have to understand that, the tax rules are clear. Section 2518 says if we're drafting for a disclaimer trust, the surviving spouse cannot have, right, a power of appointment. So I sometimes see problematic disclaimer trusts where we have boilerplate language in there where maybe they were intended for a family trust, but they're disclaimer trusts and they have powers of appointment for the surviving spouse, and that's going to jeopardize the disclaimer. So what's the other type of flexible trust option, right? A Clayton Q-tip. We like these. We know it's pretty, I think, clear that the law supports these. You have the famous case from the Fifth Circuit, and then several other circuits have affirmed this. You have Treasury who's, acknowledged this or conceded this in the regulations. It's nice, flexible planning. So some potential, traps I see are, when you're thinking through whether to make a Clayton Q-tip type of election, we may not have those timing issues that we see with the disclaimer trust, and we may not have the limitations because we can send what's not subject to the marital deduction to a totally different trust or set of beneficiaries under the Clayton rulings. But be careful on who's exercising that Clayton Q-tip election, right? I mean, I think the safe play is having an independent trustee do it so we don't have any potential taxable gift by the surviving spouse serving as trustee, making that election, and again, creating potential transfer tax issues for that surviving spouse to the other beneficiaries. So, something to keep in mind when drafting for these types of marital formulas. Let's go to the next slide. Number 3, GST, right? Just making our skin crawl, just using that acronym, GST. I love GST. It's funny how lawyers talk in acronyms, right? We have all these crazy acronyms we use, GRATs and CRUTs and SLATs. Interesting. We don't have an acronym for a spousal lifetime unit trust. So we don't have an acronym for that yet, but I think that's probably obvious why we don't. So going back to the GST, right? What do we have to worry about? Well, so really the takeaway I want to mention to all of you is, let's avoid that landmine of just relying on our boilerplate language of saying, hey, we're going to create a family trust and a marital trust, and we're going to have a third bucket, or sometimes even 4 buckets, where we're going to use GST exemption to fund a GST exempt type of trust for the benefit of grandchildren, or maybe it's for children for their lifetime and then grandchildren and beyond. And I see a lot of this, trustees going to go ahead and fund this GST exempt trust with the available GST exemption that there is, or the applicable GST exemption amount. So it's just tied to whatever the GST exemption is. And as we know, that exemption fluctuates. It's fluctuated over time. The exemptions are just at monster levels right now under TCJA, but we know that's going to go away at the end of 2025. It's likely going to go away sooner, right, with the Congress that we have right now. So, we don't want to get stuck where we're overfunding a GST exempt trust because the client thinks the exemptions are going to be so high. Sorry, I'm going to turn off my phone here. Thought I did that. Always interruptions during these things, right? I did one of these a few months ago, and the lawn people were here creating a ruckus. So I apologize for that. So in any event, we don't want to overfund or underfund just because we're basing it off the GST exemption amount. So think through these funding formulas. Maybe you want to put a collar on it. Maybe you want to cap it at a certain amount. I think it's important to talk to the client and say, how much do you actually want to put into this trust for the benefit of grandchildren? And let's flow chart this out. This is what it's going to look like. And sure, we can put some safety valves on this to say, but not to exceed the available GST exemption amount. And if the clients are very, motivated to provide for grandchildren and they're not so concerned about paying GST tax, well, we have maneuvers, right? We have other tools in our tool belt. Maybe we want to give the grandchildren or the children a testamentary general power of appointment to appoint to creditors, right? You can change the transferor that way. So there's just a lot of different techniques, I think. So it comes down to client intent. Don't rely on the GST exemption to fund those. Next slide, please. So moving right along, landmine number 4. This is an interesting one. This is a trap. I see this a lot. And, as Ted mentioned in the beginning, I would say maybe 30 to 40% of my practice, depends on the year, is working, a lot with international-based families or U.S. families who have ties abroad. And this always comes up when we're, doing intake and trying to structure the estate plan is, how do we get the marital deduction if one of the spouses or both of them is a non-U.S. citizen? So we have to remember those rules, right? We're going back to the rules that say unlimited marital deduction at death for transfers to U.S. citizen spouses. But if the surviving spouse is not a U.S. citizen at the time of filing the estate tax return, that's an important deadline. We're not going to qualify for the unlimited marital deduction. So we have a problem. In our trust, we should draft for maybe a plan B. The plan B should be if the surviving spouse is not a U.S. citizen at the time of filing the estate tax return, and give the trustee some discretion to determine this. Then we have to go down a path of what's called a qualified domestic trust. Another acronym, right? QDOT, QDT, and a QDOT is under the 2056 rules. There are very specific rules on how to properly set up a QDOT. I think, if we can go to the next slide, please. QDOTs are tricky. There's a lot of detail in my outline about QDOTs, but they have to satisfy certain requirements in order to be valid and to qualify for the marital deduction. There has to be a U.S. trustee. If there's a large QDOT, the value is large, over $2 million, then there has to be additional restrictions on the trusteeship. And then also there has to be some security so the government knows it's going to get its tax. There has to be withholding provisions to pay the estate tax. And unlike a typical marital deduction trust, whether it's, a GPOA trust or a QTIP trust, when principal distributions are made to the surviving spouse, there's no transfer tax on that amount. But with a QDOT, every time a principal distribution is made, with some exceptions for hardship, okay, then there's an estate tax that's essentially, it's a QDOT tax, but it's the estate tax based on the rate of the first spouse to die that is assessed on that principal distribution. So we're not really getting ahead by using a QDOT. All it does is defer tax until we can maybe figure out another plan. And then all of that amount is obviously subject to estate tax or inclusion in the surviving spouse's estate. So what do? I don't like QDOTs. Nobody likes them. You have to try and explain these to clients, and they don't want to hear it, right? They don't want to pay for that additional time. You always have to include it as a backup plan, but I always look for alternatives. I've tried to list a few here. We've got a wait and see approach, right? We've got, the 9 months until the estate tax return is due, and then an extension period. We may want to see if the surviving spouse is going to become a U.S. citizen. Naturalization is not necessarily on the fast track these days with where we are with COVID and the courts and USCIS, but that is an option. Portability, that's something we may want to think about. There might be treaties involved. That's something that's often missed in the international space, is making sure there's not a treaty that's on point that helps give us another alternative marital deduction or an estate tax exemption that might apply. A lot of EU countries, Germany, France, have those types of treaties with the U.S. Canada has an income tax treaty and has the equivalent of kind of a marital deduction. It's more of an estate tax credit using the marital type of deduction. And then you may want to just do the math. Maybe the surviving spouse doesn't want to stay here. The surviving spouse is not going to become a U.S. citizen, wants to go back to the home country, so you pay the tax and be done with it. So those are some alternatives. Let's go to the next slide, please. Oh, I forgot my water. Well, I'll just have to hold off here. So landmine number 5. So we're really cranking through here. This is another trap I see, again, kind of international focus, but just something to keep in mind. Here's the general rule. All trusts, right, all non-grantor trusts are foreign trusts unless they satisfy 2 tests, the court test and the control test. You may be aware of this or have seen this. I've laid them out here. Court test, just think of it this way. A U.S. court has to have exclusive or primary jurisdiction over the trust. And you can register the trust. So if your state has, Michigan has adopted the UPC, or the UTC, but if your state has the ability to register trusts, that saves it under the regulations that allows the trust to have primary jurisdiction. So those are some drafting techniques you can include just to make sure you're satisfying the court test. Control test, that's a little bit trickier because to satisfy the control test, 1 or more U.S. persons, and this is an income tax test, so U.S. citizens, U.S. residents for income tax purposes, have to have the authority to control all the substantial decisions of the trust. What are substantial decisions? Check the regulations. I've cited them in my materials. There's a laundry list of them, mainly dedicated to discretionary types of decisions, some administrative heavy types of decisions. There can't be a foreign trustee and a U.S. trustee acting together unless the tiebreaker goes to the U.S. person. So it's tricky if you're going to involve a foreign trustee or a family member who maybe is a U.S. person but is going to leave the U.S. and becomes a trustee later on. And so you just want to be mindful of that, satisfying those 2 tests. Why do we care, right? That's the question, Raj. Why do we really care? We care because we're trying to avoid a 684 issue, which is an irrevocable trust. If once it becomes foreign, that instant, all of the assets of the trust are deemed sold. So you could have a capital gain event at that point in time, which can be problematic. You're also getting into a different set of D&I rules that apply to foreign trusts. So all of the great rules we have here, where we know, taxable income that's distributed out to the beneficiaries as D&I is taxed in their hands, and you have some flexibility and under fiduciary accounting rules on what to do. Well, there's a problem. There's a problem with the foreign trust D&I rules because they apply a different regime that incorporates, accumulation, distribution types of rules, throwback rules, very problematic. And so, sorry, turning off my phone. I might just throw it the next time this happens. So my apologies. So in any event, I think, we just want to avoid a foreign trust if we can. And this is how you do it. Make sure you're satisfying the court test and the control test. And there's some safety valves if you run into trouble under the regulations for the control test. Next slide, please. Landmine number 6. So we're doing well on time. I think I have until I've got about another 25 minutes here, but I'll have my colleagues here just send me a chat and tell me exactly how many minutes I have left. But we're in landmine number 6, so we're doing well on time. This is a tricky one. Assuming that you can't or can distribute capital gain as part of DNI. This is important because there might be a situation, right? We're kind of used to the usual rules under the tax rules. Capital gain is principal. Under UPIA, fiduciary accounting rules, and if your state adopts UPIA, or if you just look to UPIA, capital gains is principal for fiduciary accounting purposes. But there might be a situation where you want to distribute capital gain recognized inside the trust out to the beneficiaries. How do you do that? Unless the trust specifically says this, which is rare, and it might be dangerous to specifically say that, because then you run into other issues with fiduciary duties of loyalty and impartiality and so forth. How do you do this? Well, don't assume you can't, because you can. And don't assume that you can, because you not always can do it. So here's the bottom line. I have a very detailed manuscript on these rules that I've included here. I've written on this topic with other colleagues of mine from ACTEC on this, so you can find some of those materials that I think are helpful. But the takeaway here is, we can distribute capital gain as part of DNI if you do a couple things. First is we have to kind of get through gate number 1. Gate number 1 is you have to satisfy one of 2 prerequisites. The first prerequisite is you have to be able to do it pursuant to the terms of the trust and state law. And that might seem doable on the face of what I just mentioned here under the statute, but it's actually not. If you think about it, I think it's actually rare. I don't think this prerequisite happens a lot. That would mean, in my view, that the terms of the trust have to exactly state what state law says as it applies to how capital gain can be distributed under fiduciary accounting rules. And that's not always the case. Trust distribution provisions are usually flexible. They're discretionary. They don't always model and tie in exactly word for word what state law says. So I'm really more focused on the second prereq. So to get through gate number 1, we can try and satisfy the second prerequisite, which is pursuant to a reasonable and partial exercise of discretion. Sounds good to me. Done. Let's go that way. So I think we just do that, right? And we have flexibility in the trust agreement for the trustee to use discretion in adjusting between income and principal and coordinating with applicable federal tax rules as it relates to DNI rules and so forth. And so now we're through gate number 1. But now we got to get through gate number 2, which is a little bit trickier. Let's go to the next slide. Gate number 2 means you have to be able to get through it under one of 3 methods. And the 3 methods I've listed here. Method number 1, probably, doable, right? Capital gains are allocated to fiduciary accounting income, and that's pursuant to the terms of the governing instrument, or it's a discretionary power given to the trust. So this is our classic tried and true power to adjust. And so if the trustee is adjusting, certain items of income between fiduciary accounting income and principal, boom, I think we can do this. But I'm not going to tell you it's easy, because we all know if we're advising a fiduciary, or if we are a fiduciary, we have other obligations. We have fiduciary duties of loyalty. We have standards of care. We have to satisfy duties of impartiality. So you can't always just rely on a power to adjust. If an income beneficiary has income available, you can't just dip into principal and then shift it to income, right? So that's a careful, calculated type of decision. And maybe your state law gives you more flexibility on that. But in Michigan, at least, we're sort of restricted on the ability to use the power to adjust. The second method, which is tricky, I don't think we can really use the second method because it's rare. I've never seen it with people I've spoken with, other practitioners, but I'll just lay it out. capital gains are allocated to principal, but you've had this consistent practice. The trustees had a consistent practice of just doing it, just deeming capital gains as part of a distribution as part of D&I to the beneficiaries. Unless you've started that practice for some reason and have justified it, I think it's probably difficult to do. Some may disagree and have done it, and they seem to think the statute allows more flexibility. But in any event, I've laid it out there for you. The third method, which is probably what is more palatable, I've done it a few times in cases where it's just been beneficial all around to do it. We've done the analysis. Is capital gains, we know they're allocated principal, but they're actually distributed to the beneficiary because there's some discretionary ability to do it. They're used to determine the amount distributed, and there is a good reason to do it. There's flexibility in the trust to do it, but the good reason would be because, hey, look, we're trying to avoid, right? The reason we're trying to do this in the first place is we're trying to avoid a triple threat problem. We're trying to avoid trapping that capital gain income at the highest possible tax bracket, which is what, 20% right now, which in compressed brackets gets there pretty quickly, when we can distribute it perhaps to a beneficiary who's going to pay same capital gains tax, but at a lower level because of bracketing. Number two, we're trying to avoid the net investment income tax, right? That 3.8% tax, that dangerous, tricky landmine tax that applies to unearned income, to investment income, with some exceptions. It hits the trust tax brackets very quickly, whereas with individuals, there's a higher threshold of modified adjusted income when it kicks in. So we're trying to avoid that 3.8%. And something we're going to touch on at the end of this presentation, we might be trying to avoid state fiduciary income tax. Remember that states also tax, unless you're in one of the 7 or 8 states where there is no tax and they've legalized, marijuana. So, good for you guys in those states. But in Michigan, we have a tax. It's 4.25%. And if I've got beneficiaries in other states, I might think about trying to distribute this so it might not be subject to, state income tax. So that's what we're trying to avoid. And that's where you may want analysis to see if the third method works. So I want to keep this moving along. Let's go to the next slide, please. Thank you. So landmine, so next slide, please. Landmine number, lucky number 7. All right. This is a trap. I see this a lot, right? And you often hear this in seminars. I think it's well done when it's talked about. I can't remember if Steve Triton is talking about this issue in this estate planning conference, but I just want to hit on it, right? We want to create flexibility in our trust to allow the trustee to qualify for a charitable contribution deduction. And we are so fortunate to have a different set of rules that apply to non-grantor trusts making charitable contributions because it's not subject to the same limitations that we have as individuals, right? We're limited generally to 60% of our AGI for cash contributions. And this past year, right, under the CARES Act, they waived that for certain cash contributions to public charities and a few others. But hey, look, our hands are tied to a certain extent. So we're advising our clients, their hands are tied. They have limitations on what they can give to charity. Trusts don't. It's unlimited. And it's not even limited to U.S. charities. Qualified foreign charities qualify as well. So it's a very nice feature. And we want to make sure we're enabling our trustee to qualify for that deduction. And how do we do it? We got to look to 642C. We've got to look to some of the corresponding regs. There's some case law on this. And the bottom line is we got to have the magic language. We have to make sure that the payment comes from gross income of the trust. And it has to be pursuant to the terms of the governing instrument and has to be traceable. So, there's decisions out there like Old Colony, which allowed it even without specific language. There was tracing involved. There's rules that say, look, as long as the distribution is made for a charitable purpose, but it's not crystal clear, you can still do it. Why risk the ambiguity? Just prevent that landmine, prevent the weird discussion with the client, prevent all that tax research you have to do and that expense you have to incur to make it work. Just draft so there's flexibility to pay these from gross income of the trust, pursuant to the terms of the trust, where it will be clear, and it's done to a charity, a qualifying charity, or maybe you give the trustee discretion to make a distribution for a qualifying charitable purpose. So let's not miss that one the next time we draft. Next slide, please. Landmine number 8. Sorry, my screen just flickered for a second. Landmine number 8. And this is usually the part of the presentation where I come in here and start screaming. So I've told them to wait in the car for an hour. I'm just kidding. Oh, they're outside. They had a snow day today, so they're sledding. So I've got some quiet. So let's look at landmine number 8. Wow, Delaware tax trap just makes our skin crawl. Saying that nobody likes it. Many of us don't even know what it is. I didn't really know what it was until I actually had to start dealing with it years ago in my practice. But, it stems from the Internal Revenue Code, and it really is just to boil it down and not try and let this slide be a time suck because we've got a little bit more to get through. It's when we have a power of appointment that's given to a beneficiary, for example, and that beneficiary exercises the power in favor of a beneficiary or other beneficiaries. And in doing that, it sends the assets to a certain place that's subject to a second power of appointment. And that second power of appointment does something very problematic. What it does is it delays the vesting of the assets or suspends the owner of the assets to a point that essentially blows a perpetuities period, right? So there's no reference whatsoever to the creation of the first power. There's no savings language that says, in no way, shape, or form is the exercise of this limited power going to sell property to be distributed to a beneficiary or be held in trust beyond the applicable perpetuities period. It's just there. It creates a second power, and that second power is what triggers this landmine. And what's the consequence? The consequence is the person exercising the power. There's a state state inclusion. And where I've seen this, let's say, for example, in family trust, right? The surviving spouse is the beneficiary. The surviving spouse has a testamentary limited power of appointment. They meet with the advisor team. They run some analysis. They think it's going to be important to change up the beneficiaries or proportions of the family trust. They exercise the limited power pursuant to the terms of their will. And in that will, it's exercised and it sends the assets to another trust that's out there. And that other trust has another power of appointment. And that power of appointment is problematic. And so what do we want to do? Just avoid it. If you don't want to subject these assets that are protected from inclusion and you don't want to subject them to estate tax, then avoiding second powers of appointment or tricky powers of appointment are arguably going to be creating a second power and extending the vesting period. I have built some savings language on this when I, draft trusts and I give powers of appointment to beneficiaries. And then they're actually exercised in the will or an instrument. I'm happy to share that language. I can't remember if I included it in my outline, but I'm happy to share it. Just email me offline, or if I get too many emails, I'll send it to the program chair so they can post it on the website. But just some savings provisions so that we're making sure we're not triggering the Delaware tax trap. And your state may have a savings statute, right? Michigan does. So if this is inadvertently triggered, there's a savings statute in some states. So you have to check your state law to determine if you have that. So let's go to the next slide. And if my colleagues here can just shoot me a chat with how many minutes I have remaining, that would be helpful. But we are on landmine number 9. So we're doing pretty well here on time. So landmine number 9, I think, is an important one, and one that I think it really is a landmine. It happens. I've seen it happen at least 2 or 3 times in the past few years in trusts that I've been involved with, or I've gotten involved with on an administration. And that's because we don't have good enough draft to enable specific assets that have built-in appreciation or IRD type assets. The classic IRD type asset is a prom note, right? Where the terms of the trust allow that asset or that right to that asset to be distributed in kind, right? And that's the foundation I'll lay here, because we know the rule, right, under These are under the 661 regs, and this is the famous case in 1940, the Keenan case. This is the Keenan gain rule, where if you are using a specific asset to satisfy a certain amount to a beneficiary, that's when you're going to run into problems. That's where there's going to be gain recognition under 661 and under the Keenan gain rule. And that's a trap. We don't want to trigger gain to the trust if we can avoid it. There are instances where you may want to intentionally trigger gain if you're doing some income tax planning or you've got some you want to absorb, but we don't want to do it inadvertently. We don't want to plant that trap. And so I think good drafting would be thinking through, all right, what assets should go where? And we specifically have provisions that those assets to the beneficiaries in kind. If we're worried equalization or trying to keep it fair, trying to keep it even, Steven, we're all clever lawyers. We can draft accordingly to try and compensate and equalize, maybe with non-built-in gain assets, so that it is fair. Maybe using life insurance to compensate again for any deficiencies, but let's not trigger gain if we don't have to. Same concept. I've seen a lot of cases where we have a problem IRD assets and we're accelerating the income, right? So classic example is the grantor has a promissory note that's still outstanding, due and owing, whether from a third party, let's say from a third party, that's a part of the estate asset at death. Has a value. It's got some built-in payments and income stream in it. And if you're using that asset to satisfy a bequest for an amount, that's a problem, right? We're going to trigger gain under the 691 rule. So how do we get around that? Well, we instead transfer the right to that IRD. What I typically do is I just transfer the note in kind, right? And you provision so that we're not, making this in satisfaction of a pecuniary bequest. 691 tells us that we can get around the accelerated income. And, importantly, I think, promissory notes are just built-in traps. I don't want to get into basis issues and all of that. I'll let Paul Lee and Todd and others who really like to talk about that issue. What happens, for example, with a sale to a grantor trust, what happens to that prom note at death? I'll let them deal with that. But, I think the takeaway here is let's try and, acceleration of income or satisfying, specific amounts using appreciated property to avoid that gain. Let's go to the next slide, please. So this is it's top of mind for me because it's a project I've been involved with for a few years, and it's becoming more top of mind as we're seeing a lot of attention on state income tax. And this deals with the issue of we all know the federal fiduciary income tax rules. We're always trying to plan around that, but we can't forget that states also have income tax. States tax trusts, and unless you're in one of the, I think, 7 states now that has no state income tax, you're going to deal with problem. And even if you aren't in those states or you don't practice in those states and work with clients in those, you're still going to have to be aware of the problem because there might be touches or some sort of connectivity to another state that has a state income tax where this could come up. And I was involved through ACTEC in an amicus brief committee where we prepared an amicus brief for the Kastner v. North Carolina Department of Revenue case that was before the Supreme Court a few years ago. And that was a very interesting project because it really helped us do a survey of what's going on in the entire country on these laws and trying to educate the Supreme Court justices, assuming they would read our brief, on how to really cut through some of the complex issues here involving, the constitutional issues like due process and the Commerce Clause. But I guess the takeaway here is, don't assume that the living trust you're drafting, once it becomes irrevocable at the grantor's death, is going to be taxed in your particular state or the grantor's state of residence forever. And also don't assume that that's the only state that's going to want to have its claws or clutches on this trust to try and tax it from a state fiduciary income tax perspective. We have to think of trusts like, corporations. They can reside in multiple states. There's no rule that says a non-grant trust can only be subject to state income tax in one state. There's no rule that says that. A few times a year, I have issues that come across my desk where multiple states want to tax this trust. And this is the reason for that, right? This is the caution I'm going to raise with you is there are really 5 different ways that a state can tax a trust. One are administration contacts, touches with the administration, or the residence of the trustee is another way. So Oregon, for example, I hope I'm saying that correctly. I'm a Michigander, so I have sort of a Midwest, sort of weird Midwest accent, but I say Oregon. I hope that's correct. If it's not, I apologize. But Oregon has a state that says that, right? I mean, if the trustee's a resident or the administration is occurring in the state, that's how the trust is going to zap this trust and have its clutches in the trust to tax it as a state resident. Those are just 2 ways. Another way is if the beneficiary is a resident of the state. Now that, as we've seen, is unconstitutional in the Kastner case, but there's only a few states now that tax a trust based on the residency of a beneficiary. And we just have to be mindful of that. Just because it's unconstitutional doesn't mean a state is going to not attempt to do that, right? So we just have to be mindful of it. I think the majority of the states, however, at least there's over 25, tax a trust based on the residence of the settlor or grantor at the time of death or at the time the trust became irrevocable. And this would be either like a testamentary trust created at the grantor's death through the probate court, or plain Jane revocable living trust that becomes irrevocable upon the death of the grantor or settlor. So if that grantor is a resident of a particular state, and the state's rule taxes a resident trust based on those rules, they're called founder. That's the way I remember them. Founder, right? The creator of the trust, resident of that state. Then that trust is a resident trust for the rest of its administration, right? So this is what we need to be cognizant of. And once we know those basic concepts, what can we do to plan, right? Sort of, I'm trying to help in the drafting and how can we fix this in our drafting in addition to just being aware of the issues. So let's go to the next slide, please. But I'm just going to cut through a couple of these maps because I think they're helpful. I use these slides for another presentation I did with David Barrick, and David gave me permission to use these ones, so I appreciate that. But let's go through these. Look, we have 25 or more states using the founder rule. You can see there's my state, Michigan. Blue means cold, freezing ice, which is what I'm experiencing right now. But we are in the club of a lot of different states that tax the trust forever and assess the state fiduciary income tax on the trust for that founder reason. Let's go to the next, please. Now we have a similar number of states, a few more that tax based on testamentary created in the state. So you can see this is probably a little bit more constitutionally founded, because what the argument that the states have in these rules, if the rules have been challenged in case law, is that the taxpayer is availing itself or herself or himself of the state laws because they're using the probate court to effectuate the testamentary trust that needs to be created under the will. And so there's a case that is often cited in this area, the Gavin case out of Connecticut, that deals with a resident trust because of a testamentary trust was created using the probate court. Let's go to the next slide, please. Only a few states here. California is sort of a hybrid. I'm not really sure what's happening in Georgia. Tennessee is going to repeal its state income tax, I think, soon, if it hasn't done it already. North Carolina was the Kastner case. Very few states will have a statute that say that the trust is going to be a resident trust if the beneficiary is a resident. So that's very hard to pull off. It's a very loose string, constitutional string, and as we've seen in Kastner, it's not going to fly, as it applies to North Carolina law. Next slide, please. And we'll go to the next slide as well. Resident trustee, and then trust administrated in the state. There's a lot of states that will tax based on these contacts, right, with administration, and then also the trustee. I mentioned Oregon is one of them. These are the states where I think allow for the most planning flexibility, right? Because when a grantor dies, you can't control the state of residence. It's happened. It's done. But for these rules, you can control it. You might be able to manufacture contacts. You might be able to do some planning ahead of time so you can manipulate and shift and move things around so we don't have trust administration contacts or enough to constitute a trust administration in the state. And certainly in this day and age, especially now over the last year, you can move the situs of trustees based on their residence. And if we go to the next slide, we're going to ignore this. I have no sympathy for these states. These are the states that have legalized medical marijuana. Well, excuse me, sorry. These are the states that have determined there'll be no state income tax, some for quite some time. And so, these are the states where you typically plan with, right? Hopefully we can get an administration in these states in order to do some planning with non-grantor trust. But we're not going to focus on these. Let's go to the next slide, please. So what do we do, right? I'm trying to help with, thinking through how we can draft to give us more flexibility so we're not stuck in a certain state forever, or at least while the trust is a non-grantor trust. And you can see my little, graphic here, the arrow pointing down at the bottom is in the red zone. You can't really change or manipulate a grantor residence at the time that the trust becomes irrevocable or at the time of the grantor's death. As you move up that line, these are things that, and you can do it, you can help do it in your drafting. So what about the location of the trust's assets, right? Change that. We can move financial assets to different custodians who are out of state. We can make sure that 1099s are coming from a different branch or a different office so that it's clear, we have source income from, a particular state if we can do it. We can move assets and put them in LLCs or types of entities to try and change the situs. There's some, nuances around that, but that will generally work. Residence of a beneficiary, not always easy to change the residence of a beneficiary. But if there's a really, really good tax reason to do it, then you might want to have that discussion with the beneficiary. These days, it's not uncommon for people to keep multiple residences, so there might be an opportunity to use one particular residence over another. And, let's not forget, we can do that in the trust so that if we've got, let's say, a big pot trust and we've got 3 beneficiaries and one of the beneficiaries lives in a state that's huge amount of problems for us, and for example, North Carolina is going to tax our trust because we have a beneficiary in North Carolina. Well, maybe we can sever this pot, create separate shares, and just deal with the North Carolina beneficiary separately and try and minimize the state income tax on the other subtrusts. Location of trustee, I think something we deal with all the time. We can draft for flexibility in our trust to allow the trustees to shift situs, to move professional trustees, bank trustees. It's a county too. There are multiple offices, so we might have flexibility on where we can designate the situs of a professional fiduciary, but we have to be careful. There's a case, I want to say it's 5 or 6 years old right now, but it's a Bank of America case out of Massachusetts, and Bank of America got stuck in the sense that because the financial institution had multiple contacts servicing multiple trusts, that the state of Massachusetts, I think unfairly, probably said, even though Bank of America is a corporate trustee in one particular state. Because of those contacts and touches in Massachusetts with the trust administration, they satisfied a residency statute in Massachusetts. So we have to be mindful of each state's residency statute. And I think there's a lot of good support for the bank in that case to not have a Massachusetts residency. But in any event, that's a case right now that professional fiduciaries are paying attention to, and something we have to be mindful of with professional fiduciaries. So I think finally, governing law, again, state where the trust is administered, governing law, we can try and control this to some extent with our drafting. We can have multiple contacts in the administration that may necessarily allow us to perhaps register the trust in a different state or have the principal place of administration in a different desired state. So in any event, those are things we can try and address in the drafting. Let's go to the next slide. I think this is the last slide. So landmine number 10, just finishing up. Here's some drafting considerations I want to leave you with. And I understand it looks like my connection here is a little bit shaky right now. I think it was good in the beginning, but we are in the middle of a winter storm here in Michigan. So I'm going to be taking cover here in a few minutes, but I know there's a recorded video as well. So to the extent you need some additional guidance, we can go to the video, or again, you can reach out to me and we can have a discussion. I'm happy to help. But look at this list. I think this is important, something we should all be thinking about when we're trying to do some state fiduciary income tax planning or management. In light of the Gavin case, maybe avoiding testamentary trustee succession, making sure we have a roadmap in place. If one trustee in a particular state's causing a problem, can we get another one in? And then trustee powers on the principal place of an administration change. Again, these are statutes that are typically baked into trust codes that will apply in each state. So having flexibility, as long as the trust agreement allows for it, for the trustee to shift situs, that should be an important flexibility in our trust agreements. Asset custody, like we talked about, the ability to change custodians, move assets, creating entities, giving the trustee discretion to create an entity to hold an asset, whether it's real estate, marketable securities, closely held interests, intangibles, very important. Decanting powers of appointment. Let's say we want to get rid of this trust because it's stuck in a particular state. I know that's a big problem in Michigan because of our founder rule. So if we have flexibility, what can we do? We might be able to transport the assets into a brand new trust in a different state, get out of the state rule, the state income tax. So that could be an opportunity with flexible drafting. And then severance of shares, I think that should be in every trust agreement, not just for GST purposes, right, under the qualified severance rules, but we want to make sure that our trust, if we need to, for the right reasons, doesn't have to operate from a pot trust, or can create separate shares, or maybe with even within those separate shares, bifurcating them even more, maybe based on beneficiary or asset class. And that leads to my point on subtrusts. And then amendment. Do we have an irrevocable trust these days? There are ways to change a trust, to adapt it. One of those ways is using a trust or a trust direct, depending on what your state, titles this sort of fiduciary who can, swoop in, make changes to the trust. So something we may want to have in our back pocket, in order to just make sure we're adapting and avoiding, if we can, state tax or paying tax in multiple states. So I think next slide is just the typical disclaimer slide. We as lawyers, we have to put this slide in our presentations. So look, I have made it through. I think we have a few minutes for questions. I'm going to read one question here, but we made it through landmines. I can't believe we did it without a tree falling on my house or something bad happening with the storm. But the question here just says the first method. So this regards the deeming capital gains as part of D&I. Can you do it? Yes, you can. You have to fit within the first gate, right? Get through the first gate, meet one of the first prerequisites. And then once you do that, you have three methods falling under one of the three methods. And the question is, the first method is similar to the first prerequisite. Is the first method not required to look to state law? And I think the answer is it does require under the first method to look to state law, unless the trust instrument says state law doesn't apply, or UPIA doesn't apply, or it absolves the trustee from applying those principles. And importantly, state law also applies under the first method because we have those typical duties that we see in most states. I don't know what law applies in your state, but at least in Michigan and a handful of states that have adopted UPIA, the duty of impartiality when you're making a power to adjust. And you can't just make a power to adjust because you want to. You have to do it because you're trying to fix an imbalance between principal and income. And if you do it improperly, you're breaching a duty of impartiality. And you can only use the power to adjust if there's no other way to do it. And so you're left with kind of going down the path of no other options. And UPIA requires that, and I think most state laws require that. But so the answer is yes, it is required to look to state law. I'll just make one more follow-up comment. Whoever asked that question, and anyone else, feel free to email me and we can find the time to chat. The problem with these deeming rules is they're really, you're kind of in the wild, wild west a little bit because there's not a lot of guidance on it. There are 14 or 15 Treasury regulations that give examples on how to do it. They're not very clear. Those that do give examples fall under only a few of the methods. And so it really comes down to record keeping, trustee discretion, making sure there's going to be no problems created with the beneficiaries, being transparent with the beneficiaries, coming up with a plan, and perhaps even getting consent on what the distribution is doing, just so there's no problem down the road from an unhappy, principal beneficiary if you have different principal and income beneficiaries. So I'm going to look here at the chat to see if there are any other questions other than when am I going to get a haircut, but it looks like we are good. So it was really a pleasure to be with you. Thanks for putting up with me. And I wish you all well. Stay safe and healthy. And I really look forward to doing in-person conferences hopefully soon. All the best. Thank you.
I hope you all had a good break. Thank you, Raj and Tia, for sharing your expertise in concurrent sessions. Once again, I'm Ted Austin, market leader for U.S. Bank's Private Wealth Management Group, and we are thrilled to be one of the gold sponsors for the 50th Annual Estate Planning Seminar. And that brings us to our final speaker. Daniel S. Rubin is the co-chair in Moses & Singer's Trust and Estate Planning Practice Group and partner in the Asset Protection Practice Group. Daniel concentrates on domestic and international estate and asset protection planning for high net worth individuals and their families. Additionally, he counsels clients on estate administrations, tax controversies, among many other matters. Daniel has been named by Worth Magazine as one of the top 100 attorneys in the nation for private clients, by Law and Politics as a New York super lawyer, and as one of the best lawyers in America for trusts and estates by U.S. News Best Lawyers. Daniel is a distinguished presenter to various professional groups and has written numerous articles on estate and asset protection planning matters for expert and scholarly publications. In addition to his work at Moses & Singer, Daniel is a peer-elected fellow at the American College of Trust and Estates Council, where he serves as chair of its Asset Protection Committee and an adjunct professor for the LLM program in estate planning at the University of Miami School of Law. He is also past president of the New York City Estate Planning Council. Daniel was recently awarded Tax Portfolio Author of the Year by Bloomberg BNA for co-authoring Asset Protection Planning and Lawyer of the Year for Litigation, Trusts and Estates by Best Lawyers. Mr. Rubin will be speaking on asset protection without the Asset Protection Trust. Let's give another warm Portland welcome to Daniel Rubin.
Thank you very much. And let me say it's a pleasure to be here with you from my dining room. I had been looking forward to being in Portland in person, and I hope to have an opportunity to do so at some point in the near future. Could we go to my slideshow, please? So, of course, I'm speaking today about asset protection without the Asset Protection Trust. Next slide. So when I speak about asset protection planning, which is not infrequent, I like to start my presentation by helping to define what exactly I mean when I say asset protection planning. So my definition of asset protection planning is the implementation of advanced planning techniques that are intended to place assets beyond the reach of potential future creditors. Now there's a word and a phrase that are highlighted there in red. I use the word advanced to distinguish it from the word advanced with a D at the end, because the techniques that we talk about in connection with asset protection planning, and in particular, the techniques that we may be speaking about today, are not necessarily advanced planning techniques, meaning they're not necessarily particularly sophisticated or complicated or require the assistance of a professional like a lawyer, although some may. But they all must be done in advance of a problem. And towards that end, as professionals assisting clients in connection with their asset protection planning, we want to do so only to the extent that we're trying to help them protect against a class of creditors that I'll call potential future creditors, which itself is a term of art. It's a term of art that refers to non-existent and as yet unanticipated creditors, meaning people with whom the client yet done and ideally not even contemplated doing business at the time of a transfer of property. And the reason why we will assist our clients largely in connection with protecting against only potential future creditors and not existing creditors or anticipated future creditors is because transfers of property in connection with planning to protect against existing creditors or anticipated future creditors may very well be what we would call a fraudulent transfer, or since 2014, after the enactment of the Uniform Voidable Transactions Act, a voidable transaction. And if it were to be a fraudulent transfer or a voidable transaction, it quite possibly would be ineffective, as well as illegitimate, unethical, and quite possibly illegal. So we need to be concerned that the work that we're doing, for the most part, is to avoid only potential future creditors. Next slide, please. The other thing that I like to define, especially when we're talking about planning techniques other than the asset protection trust, is what I actually mean when I refer to an asset protection trust. An asset protection trust is a trust established in one of the 18 states that in the year 2021 permits this, or one of a number of foreign jurisdictions. And by this, I mean a trust that a person sets up for the benefit of perhaps others as well, but also himself or herself, a self-settled trust. Because the historic, and in one of these 18 jurisdictions or one of these foreign jurisdictions, they've repealed or overridden the historic self-settled spendthrift trust rule, which is a rule that says that for public policy reasons, when a person sets up a trust and names himself or herself as a discretionary beneficiary of the property placed in trust, the trust will not protect against that person's, that settlor or beneficiary's future creditors, or existing or anticipated creditors for that matter as well. And this is, to the best as I can determine, since I'm not actually an Oregon lawyer, is also the law in Oregon, where Section 130.315B says that a creditor of the settlor of an irrevocable trust may reach the maximum amount that can be distributed to or for the settlor's benefit. And that's the case whether the settlor has any creditors when he sets the trust up or can anticipate any creditors. It's the case whether or not the trustee is a friendly family member or an institutional trustee. It's simply the rule that's existed for many centuries, but is now, since 1997, come to be repealed in a number of jurisdictions, paving the way for asset protection trusts. The proliferation of asset protection trusts, either in the United States or outside the United States, has led, in my opinion, to an unfortunate underutilization of what some might call less sexy techniques for asset protection planning, even when those techniques may better serve a client. And I think when we get to the end of the presentation, you'll see that a lot of the techniques we're discussing today are a lot easier and perhaps quite better than the asset protection trust for many of your client situations. And again, that's our topic today. It's asset protection without the asset protection trust. Next slide, please. So this is not a disclaimer that you can't rely on the information that I'm passing along to you today. This is the use of a disclaimer as an asset protection technique. So at common law, one isn't obligated to accept a gift of property, even a gift of valuable property, but rather a person can say they simply don't want it. They can disclaim it, or as it's called in New York and perhaps some other jurisdictions, they can renounce it. The utility of a disclaimer as an asset protection planning technique lies in what's called the relation back doctrine. And essentially what the relation back doctrine provides is that when a person disclaims the receipt of property, it is deemed as though the person had predeceased the moment of the transfer. So he or she, what we'll call the disclaimant, never actually received the property, didn't touch the property, never had the property. And an important aspect of that, beyond the fact that a creditor now can't reach it because it's not in the hands of the debtor who's disclaimed the property, is that the transfer of the property to some other person by reason of the disclaimer cannot be a fraudulent transfer by the disclaimant because, again, the disclaimant never actually had the property himself. And this appears to me to be the law in Oregon based on, at least in part, on the statutory citation on this page. Next page, please. Now, that's not to say that disclaimers are useful in every particular situation. A number of states preclude the use of disclaimers as an effective asset protection planning technique where the disclaimant is insolvent. So in those states, the disclaimer is not appropriate for many asset protection planning situations because those situations come up by reason of the disclaimant's insolvency. He has creditor problems to the point where he's actually insolvent. But where states don't preclude the use of a disclaimer because of insolvency, it's a very effective technique to avoid creditors. I actually have a situation literally at the moment where a client has been involved in an unfortunate lawsuit, and his mother passed away just within the past month or so. And the question that was presented to me was whether or not there's something that he can be doing with his inheritance, which is not insubstantial, to protect it from the potential of a judgment being entered against him in connection with this lawsuit. And when I identified that he was perfectly willing to have the property pass to his son, I recommended a disclaimer. And if he simply disclaims the property and the mother's will provides that it goes to her descendants per stirpes, so in the event of his death, it would go to his son, well, the disclaimer under the relation back doctrine is effectively his death for purposes of this property transfer. So his son would inherit, which is what he's okay with, and it would be unavailable to his creditors because he's never received the property. But again, that can't be done in those states where the disclaimer's existing insolvency would preclude the effectiveness of a disclaimer for asset protection purposes. In many states, if not most or even all states, disclaimers can't be undertaken for Medicaid qualification purposes. So you can't be qualified for Medicaid and then disclaim property and remain qualified for Medicaid, or disclaim property and not be subject to the look-back period for which applies for Medicaid qualification purposes. And then I came up with this statutory citation at the bottom of the slide, which appears to preclude disclaimers in Oregon if the purpose or effect of the disclaimer is to prevent recovery to be applied for the purpose of a restitution. Next slide, please. Perhaps the most famous, if you can apply that to this area of law, case involving the potential use of a disclaimer for asset protection purposes is a United States Supreme Court case from 1999 called Dry Family 1995 Trust versus United States. And this case involved this fact pattern similar to what my client is involved in. Mom died. Comes out of Tennessee. Mom died. She had a will. Her will left everything to her son. Her son had creditor problems. In particular, her son had federal tax liens that had been placed against him and his property. And so he disclaimed his inheritance under Tennessee law, which had the effect of the property going to his daughter. His daughter turned around and transferred the property that she purportedly received pursuant to the disclaimer into a trust, the Dry Family 1995 Trust, for her dad and her mom. But the government didn't lie down and say they didn't have the ability to get the property. They said instead that because these are federal tax liens, the property was subject to the lien, notwithstanding the fact of an effective state law disclaimer. Now, you may know that under Section 6321 of the Internal Revenue Code, which is the federal tax lien statute, a federal tax lien applies to all property and rights to property, whether real or personal, belonging to the taxpayer. And Dry said that, in fact, there was a right to property here, notwithstanding the disclaimer under state law, because the right to inherit was itself a property right that made the property subject to a federal tax lien. Next slide, please. Now, there are a couple issues that I've identified with the use of disclaimers for asset protection purposes, and two of them are on this slide. One of them relates to tax, and the other one relates to the question of who might disclaim. So in connection with the tax issue, Section 2518 of the Internal Revenue Code says that a disclaimer is not going to have any gift tax effect if it's what's called a qualified disclaimer. If it's not a qualified disclaimer, then it would be a gift for federal tax purposes. What does a qualified disclaimer under Section 2518 require? Well, it requires essentially four things. The first thing that it requires is that the disclaimer be in writing. The second thing that it requires is that the disclaimant cannot have accepted any of the benefits of the property before disclaiming. The third thing that it requires is that the disclaimant can't direct where the property goes by reason of the disclaimer, and it can't pass to the disclaimant or trust for the disclaimant unless the disclaimant is the transferor's spouse. And finally, and most significantly for our purposes, the disclaimer must be made within 9 months of the transfer of property, or if the would-be disclaimant is under the age of 21, within 9 months of the disclaimant turning the age of 21. What that effectively means is that under the law of some states, which don't have that time requirement as black letter law, like New York, where a court can extend the time for a disclaimer, you can have a disclaimer that's effective for state law purposes, meaning effective for asset protection purposes, but at the same time carries a federal tax consequence. Now, today, when the exemption is $11.7 million, you'd have to have a fairly substantial disclaimer of property for it to have a federal tax consequence and the imposition of a 40% federal gift tax rate. But perhaps your client is receiving a property of that amount, or he or she has previously utilized his or her exemption, or perhaps with a new administration and new composition in the Senate, we're anticipating a reduction of the federal gift tax exemption level. So there's that potential that the disclaimer might be warranted and effective for asset protection purposes, but might be unpalatable because it's going to carry a federal gift tax consequence. The other issue I've identified on the slide is the question of who might disclaim. Now, listening to me talk today, you might assume perhaps that I am competent and can disclaim property, and I hope that that in fact would be the case if anyone would be so generous as to transfer property to me. But it's also possible that the would-be disclaimant is not currently competent, in which case the question becomes, can an agent disclaim property on behalf of the principal? Here, I would suggest that because the law of agency would require the agent to always act in the best interests of the principal, that it's hard to fathom how an argument can be made that a disclaimer of the right to receive valuable property could ever be done by an agent. In other words, how is it ever in the best interests of the principal to refuse to accept valuable property? Now, you might think, what if the property is only going to go to a creditor? It's not in the principal's best interest, but I would challenge that by suggesting that paying down the principal's debts or paying off the principal's debts is a benefit to the principal. And therefore, I would find it surprising for an agent to be authorized under the law to disclaim on behalf of a principal. Next slide, please. So in terms of how we might use disclaimers for asset protection purposes, I've divided those situations into two separate classes. One I call the retroactive application of a disclaimer, and the other I call the proactive application of a disclaimer. What I mean by retroactive application of a disclaimer is a situation where, because someone screwed up the planning, we're in a position where a disclaimer is required to protect the assets from creditors. Because in the Dry case or my client's case, what would be the appropriate planning? Well, the appropriate planning would have been to recognize that Mrs. Dry's son had federal tax liens. And Mrs. Dry Mama Dry, the parent Dry, should have revised her will so that her estate did not go to her son outright, but rather went to her son in trust. Or for that matter, went to the granddaughter, who could then turn around and put the property in trust for dad. And therefore, it would have been protected from the federal tax lien. So if your client finds themselves in a situation where the appropriate planning was not done ahead of time, then the question becomes, can they now utilize a disclaimer to avoid the creditor, but of course they're not going to have the property. The other potential application of the disclaimer is proactively. So to give you an example, my wife happens to be a doctor, right? So not only do I worry about creditor issues as a practicing lawyer, but I worry about my wife being potentially subject to medical malpractice claims as a practicing doctor. So what might I do in my will? I might say in my will that my wife should inherit from me, but instead of inheriting, let me back up. Let's imagine that my desire is for my wife to inherit outright. I could say in my will that my wife should inherit from me outright, but if she disclaims that instead the property would go into a trust for her benefit. That could still be a qualified disclaimer, because the one exception to the disclaimant receipts of the property would be for my spouse. And my wife can decide at the time, does she have a creditor problem or an anticipated creditor problem such that she doesn't want to receive the property outright, but would prefer to disclaim it in favor of a trust for her benefit. Now, even if it wasn't a qualified disclaimer, it's not that so for example, let's say it's not my wife, but my son. I can provide for my son to receive the property outright, but if he disclaims it, then it goes into a trust for his benefit. That wouldn't be a qualified disclaimer in 2518, but maybe that's not an issue for my son because maybe the $11.7 million exemption more than satisfies the transfer of property and makes it a non-taxable transfer. But that would be sort of a proactive application of a proactive application of a disclaimer, not as we typically use it for estate tax planning purposes, but rather for asset protection purposes, although the concept is similar. Next slide, please. Now we're going to move on to powers of appointment and their application in the context of asset protection planning. So we deal with powers of appointment all the time, and presumably we're relatively familiar with them, but I'll go through the background just to make sure that we're first all on the same page. So there are essentially two types of powers of appointment, which is the power in a person to designate who should receive property. Those two types of powers of appointment are general and non-general. And the non-general powers are also sometimes called limited, special powers of appointment. And the essential distinction between a general power of appointment on the one hand and a non-general or special or limited power of appointment on the other hand is that a general power of appointment would allow the power holder, which is called the donee, to appoint the property to himself. Under the tax law, a general power of appointment is a power of appointment that allows a person to appoint the property to himself, his creditors, his estate, or the creditors of his estate. And the inverse, which is a non-general or limited or special power of appointment, is a power that doesn't permit the power holder or donee to appoint the property to himself or, under the tax law, his creditors, his estate, or the creditors of his estate. Next slide, please. So where this power is a non-general power of appointment, it's absolutely clear that the creditors of the donee or power holder do not have the ability to reach the property that's subject to the power. And that is because the property subject to the power is not property in which the donee has any interest that would subject it to the attachment by his creditors. Basically, the power holder doesn't have an interest in the property and his creditors can't reach any more than he himself has. Now, this is the law as well under the bankruptcy code, where 541b1 says that the property of the bankruptcy estate excludes any power that the debtor may exercise solely for the benefit of someone other than the debtor himself. Next slide, please. The question becomes, if it's a general power, not a limited or special or non-general power, does the inverse apply? Meaning, if a special or limited or non-general power is not subject to the creditors of the power holder because the power holder has no interest in the property, is property where the power holder has a general power of appointment subject to his creditors because he could give himself an interest in the property. He has the right to appoint it to himself. And curiously, or perhaps I should say surprisingly, the answer is no, at least not as a historic matter. Because the general rule, at least historically, is that it's essentially an offer to the donee to take the property or not take the property. And he can't be forced to accept the offer and appoint the property to himself, such that prior to the actual exercise of the power in his own favor, creditors won't have the ability to reach it. But that is not uniformly the case in the year 2021, and there are states that have overridden the historic rule with regard to the ability of creditors to reach property subject to a general power of appointment. And some states now, by statute, provide that property subject to a general power of appointment is, in fact, available to the power holder's creditors. Under the Bankruptcy Code, 541A1, since the bankruptcy estate is comprised of all legal or equitable interests in property as of the commencement of the case, property subject to a general power of appointment will be available to the bankrupt's creditors. Next slide, please. Now, how do you plan with powers of appointment? Well, where the general rule continues to apply, that an unexercised power, even if a general power, is not subject to the power holder's creditors, then the donee can be given a power over property or a fund of property with the idea that he or she will exercise that power in favor of himself or herself as he or she comes to need the property and absent a creditor problem, and yet the property subject to the power is still protected from creditors. But in those jurisdictions where a general power would subject the property to the donee or power holder's creditors, we're looking at the use of a limited power of appointment. Now, since a limited power of appointment can't be exercised in favor of oneself, we're looking at the grant of a limited power in favor of a third party. So imagine that my mother wants to give me access to property for whatever reason outside of trust. But she wants it to be protected from my creditors because she's as cognizant as I am of the idea that lawyers are subject to the potential for legal malpractice claims. So instead of giving the property to me or giving me a general power, she instead gives my wife a limited power of appointment over the property, exercisable in favor of a class of persons, including, let's say, my maternal grandparents' descendants, which of course includes me. My wife would then exercise that limited power of appointment in my favor as I come to need the property, and assuming that I have no creditor problems at that current time. Now, the reason why giving my wife a limited power of appointment over a fund as opposed to giving my wife the property directly is better is for really three reasons, or two here because it's my wife and potentially a third. The first reason why is because there's inherently no conflict of interest if my wife has only a limited power of appointment. She doesn't own the property and she can't appoint it to herself, so there's no conflict with her appointing it to me. The second is that since it's a non-general power of appointment over property, as opposed to her owning the property herself, it's not subject to her own creditors. And as I indicated earlier, she's a doctor and potentially has her own creditor issues. And finally, there's no adverse tax consequences to the exercise of a limited power of appointment under federal tax law, which is not really an issue here because it's my wife and I'm a US citizen, so there'd be no tax consequences anyway because of the unlimited marital deduction. But there could be adverse tax consequences in other situations where you don't have a married couple or you have a recipient spouse who's not a US citizen, absent the use of a limited power of appointment. Next slide, please. Moving on to a more sophisticated application of the power of appointment, we need to understand what the relation back doctrine means as it applies to powers of appointment. So the historic rule regarding powers of appointment and the relation back doctrine is that the exercise of the power is regarded as being part of the instrument whereby the power was created. And thus the recipient takes the property from the donor and not the power holder or donee. So some states have repealed or negated the relation back doctrine as it applies to powers of appointment. And where that's happened, what it allows is the creation of a trust, which would otherwise be deemed a self-settled spendthrift trust, which, as we noted, is not available in Oregon or in 32 of the 50 states. So the way this would work would be, I would grant my wife a power of appointment here under Arizona law, a general power of appointment, which she would then exercise to appoint the property in trust for my benefit. And because the relation back doctrine has been repealed in Arizona, she is deemed to be the transferor of the property, not me. And therefore, it's not a self-settled trust, which would be available to my creditors under Arizona law, because Arizona is not one of the 18 states that permits asset protection trusts. Instead, it's protected. And there are reasons, which I'm not going to get into, but which you can probably tease out, that it's better for me to rely on my wife's use of a general power of appointment than it is for me to actually transfer the property to my wife for her to then take in turn and put in a trust for my benefit. Next slide, please. We're moving on now to the use of tenancy by the entireties as an asset protection technique. And as you're probably aware, there are generally three forms of co-ownership of property. There's the tenancy in common, there's the joint tenancy with right of survivorship, and finally there's the tenancy by the entirety. The tenancy by the entirety requires 5 what are called coincident unities: time, title, interest, possession, and marriage. Marriage is what makes the tenancy by the entirety unique in that it's a form of co-ownership of property that's only available between married couples, which I'll probably refer to as husband and wife, although of course it doesn't necessarily need to be an opposite sex couple so long as they're married. And in most states, I'll point out, tenancy by the entirety is a form of co-ownership that can only apply to real estate, although that's not exclusively the case across the country. The unity of possession, which requires joint control of the property, means that the spouses must act together to convey title. And from creditor protection perspective, this means that a creditor of only one spouse can't execute against the property. Next slide, please. If the property is exempt from creditors under tenancy by the entirety, as a tenancy by the entirety under state law, it's going to be exempt under the bankruptcy code. 522b3b provides that any property in which the debtor had an interest in the tenancy by the entirety is exempt to the extent that it's exempt under applicable non-bankruptcy law, which we'll read as being state law, although it actually has a greater application than that. If the property is not exempt under state law, and not every state exempts tenancy by the entirety property, then there's the potential for the property to be sold in bankruptcy if certain conditions are met that are set forth on this slide. Next slide, please. There are, however, issues in connection with relying on a tenancy by the entirety form of ownership for protection of the property. At the top of the slide, United States v. Kraft, which is famous or infamous in the same way that the Dry case was famous. This is a United States Supreme Court case out of Michigan from 2002, where husband had federal tax liens against him. Property was owned as tenants by the entirety. The property was transferred by husband to wife, or rather by husband and wife to wife. She then attempted to sell the property years later. It came up as a title defect that there was federal tax liens against the husband. The property was allowed to be sold by the IRS by agreement. The proceeds went into escrow, and then the case was heard. And even though under Michigan law, tenancy by the entirety property is unavailable to the creditor of a single spouse, and by the way, the transfer by husband and wife to wife wasn't a fraudulent transfer under Michigan law as tenants by the entirety property, because it's a tax lien, the government looked at whether or not there were any this was property or rights to property in connection with the ownership of the property as a tenancy by the entirety. And in fact, it was found that there were property rights here. The right to, with the spouse, live in the property. The right to, with the spouse, sell the property. And under 6321, the tax lien attached. I also see tenancy by the entirety property, for most of my clients at least, who tend to have fairly significant wealth, as a estate tax issue. Because notwithstanding the introduction of portability under Section 2010 of the Internal Revenue Code in 2010, and the fact that it became a permanent feature of the law in 2012, I don't rely on portability for my clients for the laws that exist in connection with portability. Instead, I prefer each spouse to have sufficient wealth in her own name or his own name in order to be able to fully utilize the estate tax exemption if that spouse is the first to die, which requires the spouses to each today have at least $11.7 million in their own name. In many families, the real estate, which is the property that's owned as a tenancy by the entirety, is a substantial and sometimes the most substantial asset that they have. And tying that up as a tenancy by the entirety asset with the right of the survivor to inherit outside of the tax planning and the will is problematic from an estate tax perspective. But beyond those sort of ultra wealthy clients, the issues that exist with tenancy by the entirety protection exist in connection with the fact that the protection is lost when the tenancy by the entirety goes away. That goes away when there's a death, it goes away when there's a divorce, and it frankly doesn't even exist when there's a joint creditor of both husband and wife. Now, with regard to death, if the non-debtor co-tenant is the second to die, then the protection is great because the creditors of the debtor tenant who since died lose out on their claim, and the property is now held free of the debtor tenant's creditors' claims in the hands of the non-debtor surviving spouse. Some states have started to enact what are called tenancy by the entirety trusts. Tennessee is an example. In a tenancy by the entirety trust state, a property that's owned as a tenancy by the entirety can be transferred into trust, and it retains its benefits as tenancy by the entirety property. The utility of the trust is if the non-debtor spouse dies first, and the debtor spouse is the survivor, the fact that the property is held in trust will continue the protection that would have been lost by reason of the death of the non-debtor spouse while the claim exists. Let's go to the next slide, please. Now we're moving on completely to something that's called exemption planning, or sometimes pre-bankruptcy planning when it's done in the bankruptcy context. In bankruptcy, Section 522 of the Bankruptcy Code provides that certain property is just simply exempt from creditors. And the premise here is that the exemption of these particular types of property is needed for a debtor's fresh start in life after the bankruptcy proceeding. And state law similarly often, if not always, provides for certain property to similarly be exempt in a state court proceeding. In bankruptcy, there's a concept under 522B of the Bankruptcy Code that allows states to opt out of the federal exemption scheme and to substitute their own exemptions. In those states that haven't opted out, there's the opportunity for a debtor to choose between the Bankruptcy Code exemptions and the exemptions that exist under state law for use in bankruptcy, whichever of those two schemes is the better scheme for that particular debtor. I believe that Oregon is not an opt-out state, and that in Oregon, residents can choose between either the Oregon state exemptions or the bankruptcy exemptions in a bankruptcy proceeding. Whether or not you're using the Bankruptcy Code exemptions or state law exemptions, you would be wise to consider that any number of the exemptions that are afforded to a debtor have no real application, as far as I could see, in asset protection planning. For example, the idea that professionally prescribed health aids are exempt from creditors doesn't seem to lend itself to asset protection planning. But there are some exemptions that do, and those are the ones that we're going to speak to. Next slide, please. The most significant, perhaps, is the homestead exemption, and all states except for New Jersey and Pennsylvania provide for an exemption for a person's homestead, meaning their principal residence. And the purpose is to provide an exemption of what is quite possibly the most important of those properties that provides for the subsistence of the debtor and his dependents. The unfortunate thing is that in most states, the homestead exemption is not actually of an amount that provides for a meaningful exemption. In Oregon, it appears to be $40,000 or $50,000 if it's co-owned. And although I've never been to Oregon and I've never been to Portland, I imagine that a $40,000 exemption is not going to exempt much value of a person's home. There are, however, 6 states, Florida, Iowa, Kansas, Oklahoma, South Dakota, Texas, as well as the District of Columbia, that provide an unlimited, if not an unconditional exemption. I say not unconditional because it has the same flaw, that it's subject to federal tax liens, for example. It's also subject to non-dischargeable domestic support. But for real asset protection, we might look to having a client move from a state like Oregon to a state like Florida and put a lot of their wealth into a homestead. Next slide, please. This technique was actually sanctioned by the Florida Supreme Court in 2001 in a case called Havico of America versus Hill, where Mr. Hill, 11 days after a $14 million judgment was entered against him in Tennessee, and he was a long-term resident of Tennessee, made the move to Destin, Florida, and invested much of his wealth in a homestead. He claimed that the homestead was exempt under the Florida Constitution, Article 10, Section 4, and his creditor said that because this was a fraudulent conveyance, it shouldn't be exempt. And the Florida Supreme Court said that, in fact, it was exempt because the Florida homestead exemption as a constitutional protection trumps the Florida Uniform Fraudulent Transfer Act, saying that while we are certainly loath to provide constitutional sanction to the conduct alleged by the petitioner, this court is powerless to depart from the plain language of Article 10, Section 4. Now, this would not necessarily be the result today in bankruptcy, because in 2005, the Bankruptcy Code was substantially revised under the Bankruptcy Abuse Prevention and Consumer Protection Act. And there are now three subsections of Section 522, O, P, and Q, which limit the utility of the homestead exemption in bankruptcy under certain circumstances. 522O limits the exemption if within 10 years prior to the bankruptcy, the transfer was made with the intent to hinder, delay, or defraud creditors. 522P limits the exemption to $125,000 indexed for inflation if the transfer occurred within, if the domicile was acquired within 1,215 days prior to bankruptcy, which works out to, by the way, 40 months. And finally, Q limits the exemption to $125,000 in bankruptcy in certain situations involving securities law fraud, crimes, intentional torts, willful or reckless conduct within 5 years of the bankruptcy filing. Next slide, please. So how would you utilize the homestead exemption? Well, as I suggested, if the homestead exemption is unlimited in the jurisdiction in which the client lives, he or she might, subject to these sections of the bankruptcy code, move to a jurisdiction that provides for an unlimited homestead exemption and acquire a homestead there. The other thing that the client might need to be concerned with in a bankruptcy proceeding is the issue of forum shopping, and that's where you see the 730-day period that's under 522B3 of the Bankruptcy Code. If, however, the homestead exemption is unlimited, or if the client wants to optimize the use of the homestead exemption, as generous or ungenerous as it might be, then he or she might acquire a more expensive property or pay down his or her mortgage or improve his or her homestead with non-exempt property. But of course, unless you're in a state like Florida where the homestead exemption is constitutional, you have to concern yourself with whether or not these techniques are going to be a fraudulent transfer or voidable transaction. Next slide, please. The annuity exemption is also an exemption that might have some potential utility in asset protection planning. Under the Bankruptcy Code 522D10E, there's an exemption for payments made by reason of illness, disability, death, age, or length of service, but then only to the extent that the payments are reasonably necessary for the support of the debtor and his dependents. And unfortunately, that reasonably necessary standard has not been interpreted in a particularly generous manner by the courts. In Oregon, the exemption for annuities appears to be $500 per month plus such additional amounts that the court might deem to be necessary for the reasonable requirements of the debtor and the debtor's dependent family. Next slide. In Florida, which is sometimes considered to be a debtor's haven, annuities are exempted in an unlimited amount. What that means is that the litigation concerning debtor-creditor rights relating to annuities in Florida has focused on whether or not the thing at issue is in fact an annuity. Here's a sampling of cases. In McCollum, you had structured settlement of a wrongful death claim, which the court found to be an annuity. In Ray Pitsey, you had a payment of lottery winnings over a period of time, which the court found to be not an annuity. And in Ray Mart, you have a situation where the debtor's daughter-in-law took $2,000 of her own money and transferred it into a trust for the benefit of the debtor's children and grandchildren. The debtor's daughter was the trustee of the trust. And the day after that trust was established by the daughter-in-law, the debtor transferred all of his property, $350,000 of property, to the daughter as trustee in exchange for the daughter's promise to pay $3,000 a month to the debtor and his wife for the balance of their lives. In other words, what would seem to be an annuity. 13 months after this transaction occurred, the debtor filed in bankruptcy, and the trustee in bankruptcy claimed that this was not an annuity within the unlimited Florida annuity exemption. And the court said that the law does not distinguish between public annuities and purely private arrangements. And although this was a purely private arrangement, it was protected under the unlimited Florida homestead exemption. Now, that we utilize annuities in estate planning all the time. For example, we set up GRATs. The annuity, the A in GRAT stands for annuity. If we had the option to set this up in Florida or a state that provides a similarly generous or unlimited homestead exemption, then we might set the trust up utilizing the law of that state in order to make sure that the annuity that's being paid back to the grantor is going to be protected from creditors, as well as the remainder interest. Next slide, please. Another big exemption involves qualified retirement plans. Under the Bankruptcy Code, 522B3C and D12 provide for an unlimited exemption for retirement funds to the extent they are held in a fund or account exempt from tax under 401, 403, 408, 408A. 408 and 408A, you may be aware, involves IRAs and Roth IRAs. Oregon law similarly provides for an exemption for retirement plans under Oregon statutes 18-358 sub 2. Next slide, please. Note that the words retirement funds was highlighted on the prior slide and here as well, because there are two requirements under the Bankruptcy Code for the retirement funds to be exempt from the bankruptcy estate. The first is that they be retirement funds, and the second is that they be held in an account that's qualified under those sections of the code. For it to be retirement funds, if it's my own IRA, it's clearly retirement funds. But what happens when I die and I've designated my sons as the beneficiaries, and they, instead of taking all the money out immediately, decide to have inherited IRAs? Are those retirement funds? Well, that's an open question under the law of some states, but the issue was resolved for federal law purposes, for bankruptcy purposes, in a case called Clark versus Ramaker in 2014, where the Supreme Court said that inherited IRAs don't hold retirement funds because they're not segregated to meet the retirement needs of the owner of the account, nor are they distributed at the time of retirement, stating that the owner of the inherited IRA can withdraw the funds without paying a penalty and thus has a pot of money that can be freely used for consumption. And an owner of the inherited IRA has to withdraw the entire balance within 5 years of the original owner's death or take minimum required distributions, no matter how many years they might be from retirement. And finally, that the owner of an inherited IRA can't actually contribute funds to that inherited IRA for the purpose of saving for retirement. Now, the Oregon statute provides for an exemption for retirement plans, and that includes, by definition, under Oregon law, an IRA as described in Section 408 or 408A of the Internal Revenue Code. That seems to me to include inherited IRAs, because an inherited IRA is still governed by 408 or 408A of the Internal Revenue Code. But I'm not an Oregon lawyer, so you may want to check that with Oregon counsel before you rely on the protection of an inherited IRA from the beneficiary's creditors. Next slide, please. Which is a nice segue into the use of trusts for the protection of inherited IRAs, whether because you're concerned that the client may file in bankruptcy or because you don't know that your client's children or beneficiaries are going to stay in Oregon, if in fact Oregon law protects inherited IRAs. Here, therefore, you might utilize the same technique that we use for protecting all sorts of property, which is the use of a third-party trust, meaning that the beneficiary of the IRA is not going to be my son, it's going to be a trust for my son. The problem is that you want to have a confluence of asset protection through the use of a trust while not destroying whatever potential stretch you could get or deferral of income taxation through having a designated beneficiary, which is a defined term of art under the code, with an actuarial life expectancy. And trusts are not designated beneficiaries unless you could see through the trust, look through the trust, and determine what beneficiary exists who has an actuarial life expectancy and which is the shortest of all the actuarial life expectancies of the beneficiaries of the trust. Next slide, please. Essentially, this means that the trust must be one of two types: a conduit trust or a discretionary trust. A conduit trust is a trust where the trustee is obligated to withdraw the minimum required distribution out of the account and then turn around and pass that out to the beneficiary on a current basis. No issue there with determining the actuarial life expectancy. The issue is that it's imperfect from an asset protection standpoint, because while the balance of the account is going to be protected from creditors, the amounts that are being paid out to the beneficiary on a current basis obviously are not. Therefore, we might turn to the use of a discretionary trust, where the trustee is obligated to pull the minimum required distribution out of the account, but is not then obligated to turn around and pay that out to a beneficiary. In that sort of a trust, where we're protecting not only what's in the account, but also what's been pulled from the account and remains in trust, we need to be very careful that we're not going to violate the rule that requires us to be able to look through the trust, find a beneficiary with an actuarial life expectancy, and determine who has the shortest actuarial life expectancy. Next slide, please. Finally, with regard to exemptions, I want to discuss the exemption for higher education expense accounts, and specifically here, Section 529 accounts. Bankruptcy Code 541B6 provides that funds contributed to a Section 529 account are protected from creditors in bankruptcy, provided that they were contributed at least 2 years prior to the bankruptcy filing. If they were contributed within 1 and 2 years prior to the bankruptcy filing, they're protected or exempt, but only to $5,000. And if they were contributed in the prior year, they're not exempt at all. In a state court proceeding under Oregon law, it's completely exempt. Now, why do I like 529 plans for creditor protection purposes? Because as you're probably well aware, the amount that can be put into a 529 plan can be or become quite substantial. I have 3 sons. They each have a fully funded 529 plan. And because college, at least private college, is so expensive, there's a lot of wealth in those accounts. And because I'm the owner of those accounts, there's nothing prohibiting me from pulling the money out and not using it for my kids' education, except for the fact that it would be subject to tax and penalty. But it's essentially my money to use as I want. But it's in a protected form, at least it would be under Oregon law and under federal bankruptcy law, because I've made the contribution more than 2 years prior. So it's a nice way to protect a substantial amount of wealth from creditors where the client has the access to the wealth under both federal and state law. Next slide, please. Okay, so my presentation is asset protection without the asset protection trust. That doesn't mean that we shouldn't spend at least a few minutes talking about the use of trusts for asset protection purposes. Because remember, my second slide defined what I mean by an asset protection trust, and that's a trust where I set the trust up and name myself as a discretionary beneficiary. But there are other trusts that are similar in terms of their potential to benefit me, but that I am not actually a beneficiary of. The 3 types of trusts that I'd like to discuss are special power of appointment trusts, or sometimes called SPATs, inter vivos Q-tip trusts, and spousal lifetime access trusts. Next slide, please. The special power of appointment trust is essentially a trust that's set up for the benefit of some 1 or more third persons. But in addition to being for the benefit of 1 or more third persons, there's a clause in the trust agreement that permits a third party in a non-fiduciary capacity to exercise a limited power of appointment in favor of a class of persons that by definition would include the grantor. So I might set up a trust, name my 3 sons as beneficiaries, and give my cousin David a special power of appointment to appoint the property to any 1 or more of my parents' descendants, which of course includes me. Because I'm not a beneficiary of the trust, it's not a self-settled trust, and therefore doesn't violate the rule in New York or Oregon that says that a self-settled trust is available to one's creditors. And yet my cousin could always exercise that power in my favor, and I would have the use of the property. This is a confluence of the earlier discussion of powers of appointment with the use of a trust. Next slide, please. The second of the 3 types of trust would be an inter vivos Q-tip trust. So imagine that I'm concerned about estate taxes. I'm married to my wife, who's a doctor, and I believe that it's important for each of us to have $11.7 million in our individual name because we don't know which of us might die first. And I want to make sure that the spouse who dies first is able to utilize the full exemption amount without relying on portability. So I could take $11.7 million of my $23.4 million net worth and transfer it to my wife. There'd be no tax on that, but what would the problem be? It would be that my wife's a doctor, and I'm concerned about the possibility of medical malpractice. So instead of utilizing an outright marital gift, I would transfer the property into an inter vivos, which of course means lifetime Q-tip. I set it up while I'm alive, not under my will at my death. I transfer $11.7 million into it, and it's protected from my creditors because I'm not a beneficiary. It's protected from my wife's creditors because it's a third-party trust, and that's essentially how trusts work. They're protected from the property is protected from the beneficiary's creditors. And if you were concerned about, if I was concerned about getting the property back, well, during my wife's lifetime, distributions could be made to her, which I would hope she would then use for our mutual benefit. And after her death, it might provide that the property is then held in a credit shelter trust for the benefit of me and my children. Under Treasury Regulation 252523 F1F, example 11, that is an effective device to keep the property out of my taxable estate when I later die, under 2038 and 2036. And for asset protection purposes, that remainder credit shelter trust is not considered self-settled by me under the law of some states. Florida and Oregon are two of those states. Here's the citation for the Oregon statute. Next slide, please. Finally, the idea of a spousal lifetime access trust. Very simply, it's a trust that I set up for the benefit of my spouse. During her lifetime, she has access to the trust, and she can always use the trust for my benefit as well by getting a distribution, which she then uses for our mutual benefit, or simply transfers the property received back to me. That's why it's called a spousal lifetime access trust. I have access during my wife's life. My two concerns with that type of trust would be in the event of my wife's death before me, or the possibility of our divorce. I happen not to be particularly concerned about the possibility of my wife and I getting divorced, but if I were, I might say that the beneficiaries of this trust are my wife and my descendants, as opposed to saying my wife, whose name is Laney, my wife Laney. That's what's sometimes called a floating spouse clause. And if my wife Laney and I divorced, and I'm cut off from accessing the assets in the trust, as she would be as well, all I would have to do to get new indirect access to the assets in the trust would be to remarry. And now my then current wife is a beneficiary, and distributions can be made to her for the purpose of her then using for the distributed property for a mutual benefit, or just transferring the property to me. The issue of death can be resolved in one of two ways. One way would be for me to set up the SLAT and at the same time have my wife acquire, ideally in a life insurance trust, a 20 or 30-year term policy on her life. What that means is that during the term, I don't need to be particularly concerned for financial reasons of my wife's untimely death and me being cut off from accessing the SLAT, because if she did die during the term of the insurance policy, X millions of dollars would come into the insurance trust for my benefit. What this does is it buys me time, 20 or 30 years of time, with the idea that in the last 6 months of the 20 or 30-year term, my wife and I will reassess our financial situation. And if the idea of my wife dying the day after the term insurance expires would put me in an unfortunate financial position, then what we would do is, in that last 6-month period, get a distribution to my wife from the SLAT, which she then transfers to me to put me in the financial position that I would need to be in if, God forbid, my wife were to predecease me and I would be cut off from accessing the SLAT. What is 20 or 30 years going to buy? It's going to buy me enough time that I probably will no longer be concerned about creditor issues, because I don't know that I'm going to be practicing law when I'm 80 years old. The other option would be to give my wife a testamentary limited power of appointment. I would ideally do that in a state that, as we saw earlier, negated the traditional relation back doctrine as it applies to powers of appointment. I think that's the end of my presentation. Let's see the next slide. In fact, it is. That's a pre-pandemic and younger and handsomer picture of me. Thank you. And the next slide. Thank you. I can't see any of you, but I'll make the assumption that you were all incredibly attentive, and I appreciate your time and attention today. I think there's several questions, and I will try to address the ones that I'm in a position to answer. So let me take a moment. Has well, here's an interesting question. Has anyone ever seen a malicious exercise of a power of appointment? Similar issue with the trust protector powers. Not for the holder's benefit, but specifically to hurt the grantor. Always worried about that in divorce or other family situations. So I'm uncertain that I'm getting at the crux of your question, but for the SPAT at least, and also I think more generally, the grant of a limited power of appointment that we hope is going to be exercised in favor of the intended beneficiary, I suggested that we would want to have a class, right? So, my wife would be given a limited power of appointment over property, and the potential recipients or beneficiaries of the exercise of the power would not be Dan Rubin, but instead it would be, my mother's descendants. So it's not specifically limited to me. That may be important for estate tax purposes and may be important for creditor protection purposes. But of course, we don't anticipate that my wife is going to exercise that power in favor of my brother, although, as this question suggests, it's certainly possible that she could. I think that my mother at least, would need to be concerned with whether or not there's that possibility and how significant that possibility might be before she relies on that as a technique to protect me from my potential creditors. Another question, what if the power of attorney permits a disclaimer by the agent in the event of incapacity, both for tax and creditor reasons? So that's an excellent question. It relates back to my point that I don't see a agent being able to exercise a disclaimer for a principal for creditor protection purposes. That doesn't necessarily mean that they can't exercise a disclaimer for tax purposes. In fact, there are situations, as one of which I'm aware in New York, where the court, which is required to authorize the disclaimer by an agent, authorized the disclaimer where it was in the best interests of the principal to effect the disclaimer. My specific concern is that I don't see how it's ever in the principal's best interests when you're looking at it from a creditor protection standpoint for an agent to disclaim. Because if the disclaimer didn't exist, to make sure my point is clear, the property would have gone to pay down the principal's debts, which is an obvious benefit to the principal. The disclaimer is going to take the property away from the principal and pay down none of his debts. So it's hard to argue that it was in any way in the principal's for the principal's benefit. Thank you for those questions. Again, thank you for your time. I think my time is up now. It's been a pleasure. I hope to be out in Portland at some point in the future to see your fair city. And again, I thank you for your attention.
Well, thank you everyone for joining us today. We now have an hour for networking in the exhibit hall and lounge. Maybe grab a sandwich and come on back and visit the sponsor booths to learn about their services and how they might be able to help you, and enter to win some door prizes. Keep in mind that even though our seminar ends today, this VFair site will be up for an additional 30 days. Recordings of the presentation will be available to all paid registered attendees here for 30 days after the event. The sponsor booth information will also be available, so you can still visit and gather information that you might have missed. Although the booth reps won't be live after today, so maybe take a chance to go say hi to them while they're here. I'd also like to remind all attendees that you can contact us through the epcportland.org website for any questions about your continuing education credits or regarding upcoming programs. Thank you so much for attending our 50th Annual Estate Planning Seminar, and we hope to see you all in person next year.